The cross-asset sell-off put on pause. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld, kicking you off to the closing bell, about 2 hours to go. We're actually looking at some gains. You look at the S&P 500, currently up about 0.2%. We were up higher earlier, but the screen, it's still green, so we'll see how we end. Big tech doing a little bit better. The Nasdaq 100 up about 0.7%. And I had to check this and then check it again. We're actually seeing yields fall today. It feels like a long time, but you look at the 10-year Treasury yield down about 5 basis points right now. Of course, still at very elevated levels, near 4.75%, still hovering near the highs of about 2007 or so. And I wanted to also highlight the VIX. It's lower, but it's higher relative to its recent history. The VIX currently with a 19 handle. We'll see if we get to about 20, Romaine.
All right. Of course, this market has been battered around a lot here by what we've been seeing in the labor market. The latest data, roughly 24 hours since we got the last government data on job openings. And now this morning, we got another interesting data point here. Of course, this comes from private payrolls tracked by ADP Research here, coming in at around 89,000, about half of what we saw in the previous month. And more importantly, the slowest pace of growth that we've seen going back to 2021. This gets us back maybe into that sort of bad news is good news is bad news type of scenario, as this market really is trying to look for any sort of evidence out there that the Fed might actually have a little bit of a breathing room to not only stop raising rates, but maybe even potentially cut those rates. But of course, you know, that could be a bit of wishful thinking here as we talk about, well, continued labor strife. This was the summer of strikes now, so drifting into autumn here. The latest news this morning, 75,000 workers over at Kaiser Permanente walking off the job. Now, we should point out this is just a 3-day strike here, a planned strike they've been doing here. But all non-essential health services effectively shut down. So think if you're going to an optometrist, a dentist, or even for just basic routine checkup with the doctor. This has a lot of concerns right now just about the power of labor right now, the inflationary impact that could potentially have, and of course, the reaction function by the Fed. Of course, that changes the calculus for investors. And Katie Greifeld, another big part of that calculus, of course, is where yields are going, or more importantly, where they've been here. We talk about that premium that investors usually demand, that earnings yield premium to hold stocks relative to maybe what they would get if they just bought and hold bonds. I'm told that premium is basically non-existent right now.
Well, I have good news. I have a whole chart to explain just that. Like Romaine said, you look at the S&P 500's earnings yield right now. It's forward earnings yield, and you compare that to the 10-year Treasury yield. That premium that equities enjoy, what you earn from equities, it's been narrowing and narrowing. And right now it stands at about 0.3738%. We haven't been negative on this spread going all the way back to about 2002. But as you can see, the direction of travel is clear. That's where we're headed. And of course, a big part of the reason why that we've seen bond yields rise, it comes down to what's going on in real yields, of course. When you think about what we're seeing in terms of the nominal yield, it hasn't been inflation expectations. It's been those real yields. In blue, you can see we've been getting higher, currently sitting around 2.4% when it comes to 10-year real yields. And you think about the relationship to the equity market, as you can see, as real yields go higher, the S&P 500 has trended lower. That gap is growing, Romaine. It'll be interesting to see how those lines actually come back together.
All right, let's get some insights here out of our next guest to help kick us off to the close. Bill Gross joining us right now, the co-founder of PIMCO, and out today here with his latest investment outlook, a look at some of those yields, a look at the risk of holding on to stocks and the differential, I guess, in the premium that, as we just said, Bill, doesn't seem to exist anymore. If that risk premium isn't there, Bill, I am curious as to exactly what equity investors would have to hang their hat on to justify entering into this market.
Well, I think, Romaine, they would have a hat to hang on, perhaps AI and the potential increase across the economy in terms of productivity. As of now, we don't really know what that is. As well, they would hang their hat on a stronger economy that may continue to persist as opposed to a recession that many are expecting. That's what they would hang their hat on. I would go the other way and take the hat off.
Take the hat off. And I mean, we know in the past from speaking to you as well as some of your other public statements that you took that hat off a while ago here. I mean, what hat are you wearing right now?
Well, let me explain it this way. I think PE ratios are coming down. Katie explained it in terms of an equity risk premium being close to, basically the bond market, and meaning that there's little risk in terms of stocks relative to Treasury bills or short-term Treasury notes. I would put it this way. Give me 30 seconds for an example that. A PE ratio at 20, turn it upside down as an EP ratio at 5, so an earnings ratio at 5. A PE ratio of 20 was a year and a half ago, and since then, real yields, as Katie pointed out, have gone up by, a good 350 basis points. If, and I'm not saying this is going to happen, but if the earnings yield ratio, the EP ratio, went up from 5 to 8.5%, then PE ratios would be down around 12 or 13. Now that's a little old school. That's Gordon discount, dividend discount model type of thing, but it does indicate the direction in terms of PE ratios that they might move if we see a situation of real yields still at 2.40%.
And let's break down what we've seen in terms of nominal yields. As you mentioned, real yields very high, and they've been in the driver's seat, really, if you think about this rise in the 10-year yield. Talk to us, though, about break-evens. Do you think that inflation expectations should be higher here, given what we're seeing in the energy market?
Yeah, I think it should. And, the break-even rate for the 10-year, amazingly, is rather stable between 2 and 2.3% today, I think around 2.34%. And so that's the expectation for inflation. I would say it's more like 3. Getting down to 2 is going to be very difficult going forward. And so, that to me means that nominal treasuries, take the 10-year again at 4.75 or 4.8, that nominal treasuries are basically based upon an expectation for a 3% Fed funds rate over a long-term basis. There is a equity risk premium that you talked about. There is a term premium for bonds as well of about 1 to 1.25%, because that's the risk of owning a 10-year versus a Treasury bill. And so if Fed funds settle around 3 to 3.5%, a 5% 10-year Treasury is decent value. It's not great value.
What is great value, though? When you think about 5% on a 10-year Treasury, we haven't seen that for 15 years plus. If that's not great, what is great?
Well, it's greater. There's no doubt about that. But 5%, again, would be a normal bond term premium of about 1.25%. Under 3% inflationary expectations. So that's okay. And I know corporate spreads have widened out a little bit, and that makes them attractive. But what I think has happened, Katie, in the past several weeks, and the market is beginning to recognize Treasury supply, based upon a $2 trillion deficit. They're beginning to recognize, basically the selling of bonds by the Fed in terms of the QT. They're beginning to recognize higher for longer as well. And so those two factors have been important in terms of the current rise. What I've seen in the last week is that the bond vigilantes, to the extent that they are now individuals owning, billions and billions, hundreds of billions of bond ETFs, they've been spooked over the last week or so by declines of 2, 3, 4, 5% in their ETFs. And so I think they're joining the crowd in terms of selling, and we're seeing a little bit of an oversold market here headed to 5%.
Certainly oversold, but I do worry, Bills, about some of these external events. Of course, yesterday there was a lot of hoopla around basically the Speaker of the House losing his position here, and whether this was symptomatic of just the dysfunction in Washington. You mentioned the federal debt. We know debt servicing costs have gone up from sub 2% here for the government to, I think, now somewhere in the 4 to 5% range here on average. How much of that ends up becoming a factor in investment decisions, or can you ignore it?
Well, I don't think you can ignore it. You know, we're going to see the point again 30 days from now in which they have to vote, and we'll have a new speaker, I assume. But to me, it indicates, disruption in terms of the process, additional disruption based upon what we've seen, because 10 conservative Republicans, basically are running the show in the House. And so that will increase volatility in terms of all markets, and certainly is a negative.
Well, and yes, we can blame those 10 Republicans, but there really hasn't been a major player, at least when it comes to, fiscal conservatism for quite some time, at least not one that is listened to. And I'm talking on both sides of the aisle here. So this isn't just a party issue here. It just seems that whatever appetite that we had to address the fiscal situation, at least for now, just seems to have completely dissipated.
Well, yeah, the fiscal situation is very much of a negative. I mentioned $2 trillion in terms of a deficit, at least for this particular fiscal year. And the incredible thing, you've pointed out in the past, that the higher level of interest that the Treasury must pay is going to add increasingly to this deficit going forward. And so we don't have much to hope for in terms of deficit spending. If anything, you would think that the fiscal side would come in and start spending money if we have a recession or a significant slowdown. So deficits, as far as the eye can see, is what I can see, and that puts obvious supply pressure going forward, probably twice as much as what we've had over the past year or two in terms of Treasury supply. So,
well, it makes me wonder then, Bill.
We're going to have to see what happens.
Yeah, well, it makes me wonder, Bill, about the whole ideology of bond vigilantes. Is that something that even really exists in this current environment? Is there someone or some group of people that have that much sway still in the market?
No, there isn't, Romaine, and I use the term loosely because back in the day, the vigilantes that Ed Yardeni talked about were in control to some extent. These days, to speak about an ETF holding by an individual as representing a bond vigilante is a little loose, a little bit of a stretch, as I suggested. But what I've seen in the past week or two are significant sales of ETFs. The volume on AGG or the volume on BND, which are $100 billion ETFs, has been significant. And so what I see are these smaller vigilantes joining the Treasury, joining the Fed in terms of negative pressure for bond prices and higher pressure for bond yields.
Well, just to ask sort of a simple scene-setting question, if it's not vigilantes, what do you think is driving this move at the long end? Do you think about 80, 90, 100 basis points move higher in 10-year Treasury yields over the past couple months? What's driving that, and what's going to bring it lower?
Yeah, I think that's important, and we talk about a forecast for a 10-year Treasury, but we should also talk about the shape of the yield curve. And as you mentioned, longer yields are headed higher, shorter yields not so much, and we have a less negative yield curve, which I think is important going forward in terms of markets. So what's driving it? I think to some extent the sales of ETFs, which own long duration as opposed to short duration, is important. I think the mix of Treasury sales is important going forward. Next week we'll see a 3, a 10, and a 30-year combined offering of perhaps $100 billion. And so the long end is being pressured based upon supply and based upon expectations for a stronger economy than what was the expectation 3 to 6 months ago.
All right, we're in conversation right now with Bill Gross, the co-founder of PIMCO. We do need to take a break, but Bill is going to stick with us. We have a lot more questions coming up here on the mortgage market, of course, with rates now at more than 7%, and some questions as well about merger arbitrage. Stick with us. The Close, right here on Bloomberg.
focus to the housing market and the impact of a 30-year fixed mortgage rate rising over 7%. Back with us now, I'm thrilled to say, is Bill Gross, the co-founder of PIMCO. And Bill, you tweeted yesterday, 30-year mortgage at 7.7%. This shuts down the housing market. And to that point, Bill, it feels like everyone is unhappy here. You have sellers struggling to sell, and buyers don't necessarily want to buy in this market either.
Well, I think that's true. That speaks to the secondary market. What I was suggesting as well is the new housing market, construction, new housing starts, and so on. And it's hard to see, despite the relative success, I guess, of home builder stocks in the past several months. It's hard to see how new homes can be sold with a 7.7% mortgage and maybe some points added onto that. So, typically housing, Katie, leads the economy by 6 months or so. And so what we've seen is a relatively robust housing market, but at 7.7%, that doubles and in some cases triples the payments, the home payments that a homeowner would have expected, perhaps a year and a half ago.
Yeah, absolutely, Bill. And I am curious, though, too, if we talk about the secondary market, and our apologies to our viewers if you hear the phones, there's a national test going on here that's going across the newsroom and beyond. So no worries there, Bill. You weren't the only one with the phone on. I am curious, when we look at spreads, I mean, you mentioned earlier about corporate spreads, but I was taking a look at MBS spreads as well, and they've really sort of widened out to, I think, probably some of the cheapest levels that we've seen, at least since the big housing bubble collapse a few years back here. I'm curious if what we can extrapolate about that here. If you have that tightness in the housing market and nobody's making money in MBS here, what's the equal sign and what comes after that?
Well, I think you're correct. I mean, the spread between a 30-year mortgage, and there's an index on your Bloomberg screen that will point that out at 7.7% or so, but that spread relative to a 10-year government is significantly wide. To me, what that portends going forward, if that spread narrows, is that it's very much of a benefit to mortgage REITs, such as Annaly's, such as AGNC, that yield about 16%. Now, this particular sector thrives on a less negative yield curve, and it thrives, basically on lower market volatility in terms of the Treasury market, both of which, hopefully we're going to see going forward. So is a 16% yield on a mortgage REIT a safe yield? Not necessarily. They've been cut before if these mortgage REITs, have been over-levered. But I think they learned their lesson. I think we can move into this sector, and capture the yields as well as perhaps a 10% price appreciation if the mortgage spread narrows.
And Bill, I did want to switch gears here in the couple minutes we have left with you and ask about something that you had in your investment outlook. You wrote that some of the best bets right now are arbitrages in merger and acquisition deals. You specifically named Microsoft buying Activision Blizzard. I'm curious whether you view that as idiosyncratic to that specific deal, or are merger arbs in general more attractive right now?
Well, they've become more attractive in the last week or two as liquidity in both markets, in the stock market and the bond market, has declined. And in some cases, as I was explaining to my wife last night at dinner, margin is required to maintain those positions. So, ATVI, Activision, to my way of thinking, it's 7 days away from approval by the UK Regulatory Commission. That means the price goes from 94 to 95. That's a point. That's 1.1%. Is that a big deal? It is over 7 days. And so, there are other examples such as Capri, which owns Jimmy Choo's, and and other lines that are being acquired by a private investor, and that's selling at a discount of 10, 11, 12%. So there are situations, not a lot of them, but situations in which arbitrage can produce returns, certainly much higher than what we've seen in the equity market over the past few months.
All right, Bill, going to have to leave it there. Great to catch up with you. Bill Gross there, he's the co-founder of PIMCO out there in California with his latest investment outlook. A lot more coming up here on the show as we count you down to the close, including a conversation with Brad Jacobs, the chairman of XPO, the big freight and logistics company. He's coming out with a new book chronicling his career and, more importantly, maybe providing some advice for how to be an entrepreneur.
Plus, we'll speak with Wilbur Ross, former U.S. Secretary of Commerce and the founder of W.L. Ross & Co. for his insight on the state of the economy and the Fed's next move.
And a conversation on AI with Mandy Long, the CEO of the software firm BigBear.AI. Her insights on using the latest technology to help companies solve some of their problems, including supply chain and cybersecurity issues. That conversation and so much more coming up in a bit. This is Bloomberg. All right, welcome back to The Close. Romaine Bostick here alongside Katie Greifeld. And Katie, I guess the good news here is that yields, at least for today, have stopped rising. Unfortunately, the equity market doesn't really seem to be responding to it too well. They were pretty much higher across the board earlier in the session, but now starting to hit session lows. Yeah,
kind of a pop and a fizzle when you look at the S&P 500. We're still positive, 0.1% higher or so.
You missed your opportunity to use the snap, crackle, pop.
That would have been cute. I didn't want to torture it too much, but here we are. In any case, stocks off their highs.
Yeah, I like a good corny pun from time to time here. Stocks off the highs. Another thing that we haven't had a chance to talk about that I know we're going to get to in just a bit here is there's a lot of volatility going on right now around oil and energy. You're seeing that in stocks, and of course you're actually seeing that as well in WTI prices themselves. As last time I checked, we're down about 5% here on the day here. So that real sort of break above 90, and everyone was basically saying $100 a barrel is basically a matter of if, not when. We're now sliding pretty in the opposite direction.
Yeah, it's pretty amazing. Back at 84 handle on price of the barrel of oil. Like you said, 100 seemed like a certainty, not so much right now.
All right, a lot more coming up here on The Close. Stick with us. This is Bloomberg. This is the countdown to the close. The broader market's on the back foot once again. Let's get a check, though, of what's happening in the commodity space. Abigail Doolittle is standing by right now with our commodities close. Abigail.
Well, commodities are really on the back foot, Romaine. We have the Bloomberg Commodity Index down more than 1.5%. And here's one of the big weights. Crude oil down 5.6%. WTI crude, what goes up must come down. Last week it was at 95. Now we are down more than 10% from those levels, or about 10%. And most of that was into today. But then, of course, we had inventory numbers that were more than expected weighing. Copper also down 1.3%. Dr. Copper, a tell on expectations for the global economy. Wheat down 1.7% in its worst year, down about 30% since 2009. And coffee also down 1.6%. So, again, a lot of pain for commodities. Let's look closer at that crude oil move, though, because it really is pretty dramatic. If we go into the Bloomberg terminal, here we can see over the last year there was a bit of a downtrend. Then you have this up move, a big up move, in fact, up about 40%. But this fast 10% slide, now we're back below the 10-day or 50-day moving average, maybe heading to the 200-day moving average. One thing I would point out, Romaine, is we recently had a golden cross for crude oil. Typically, that's bullish. So maybe there's just some back and fill going on. If that is the case, the question is, how far do we go down before going back higher?
Abigail Doolittle with a look at the commodity space, one of the big stories of the day unfolding. Let's look a little bit more long term right now. The Greenwich Economic Forum is underway this week, and our next guest stepping away from the forum to join us and give us his perspective on what it takes to build a successful business. Brad Jacobs is the chair of the logistics firm XPO and has a new book titled how to make a few $1 billion, breaking down the biggest lessons he's learned from his over 44-year career. That book will go on sale in a few months, but I'm told you can pre-order it now, if you would. Brad, great to have you here in Studio 2.
Fantastic to see you,
you know, I was thinking about the title of your book and the expertise that you have, particularly when it comes to M&A activity. And I actually tried to go, one of the great things about the terminal, you could kind of go through and look at all the past acquisitions that you made at XPO, at United Rentals. I lost count after like 502 or something. I mean, it was a lot. You've been very acquisitive, and I'm curious as to what you've learned from that history of M&A activity that can be applied to just regular folks who maybe are, as your title says, trying to make $1 billion.
Well, first of all, great to see you.
Yeah.
I learned a lot because I did about 500 acquisitions, teams I've led, executed, and then integrated.
So I got close to
you
it.
got
to
close,
the number.
You got close. You did a good job.
All right.
And I made pretty much every mistake you can make, particularly in the earlier ones. But what I learned mainly from M&A, and I write about it in the book a lot, is my approach to M&A changed a lot from when I did it in the earlier years to later. In the earlier years, I postured a lot, I played cool, I made the seller wait a few days or over the weekend and sweat it out. And I just realized all I was doing was annoying the sellers. I wasn't accomplishing getting the deal done. So I just became completely transparent. When I liked a deal, I just said, I really like this company. I'd like to buy it. And here's the price, and here's the terms that work for me. Does that work for you? So that was a big change in my approach towards developing a relationship and getting a deal done.
When you are trying to get deals done and you're trying to sell the potential company that's being acquired or the executive there, is it always just pretty much a financial proposition, or is it more some of the, I guess, less tangible factors that ends up swaying that deal?
It's much more than, I mean, financial has to work.
Yeah.
I mean, the numbers have to work, it has to be accretive.
Right.
It has to be a financial reason to do the transaction. The price has to be right. But it has to be much more than that. There's going to be a real strategically compelling reason to do it. There has to be a rationale to doing it. What is that bringing to the table? Like, why does that change the company? What will our customers think when they read the press release, we bought that company? Will they love that? Will they go, oh, it's just a distraction? What kind of people are we getting into the company? How can we apply our technology to that company in order to grow it? So there's a lot of different things, and it's not just financial.
And how would you say that the environment for M&A is right now? When you think about some of the defining characteristics of today's economy, high interest rates, high inflation, regulatory concerns, how has that affected the M&A appetite out there?
It's very different in different industries. So some industries are already well consolidated. There's not much to buy. Private equity has gone in, they've bid up prices, and now private equity owns a lot, so they're kind of selling. There's other industries that are less along the curve, and they're earlier in the stage of consolidation. They're more fragmented. There's plenty of things to buy at different sizes. And I'm going to be spending my time on my next company consolidating an industry that has similar characteristics to what we had before. In other words, it's large, it's fragmented, it's growing, there's synergies, there's advantages to being big, there's economies of scale. That's the kind of things I look for.
Well, let's talk a little bit about the current makeup of industries, because if you think about the strategy that you took with United Waste, United Rentals, and XPO, it was really targeting some of these companies that could be rolled up into a market leader. When you look at the landscape right now, are there any industries that fit that profile?
Yes, but I'm not going to tell you which ones because I don't want competition. when I select the one I want to do, obviously I'll tell you that. And then I'll tell you the other ones that I overlooked and why I overlooked them.
Well, I tried.
You tried, but I am curious about the competition here. I mean, you mentioned private equity. You obviously also have your own private equity firm here. I feel like there's just a lot more competition now for deals, given how much money has flowed into this space. Is that not what you're seeing?
There's always been competition. There's always been billions and billions of dollars.
Is the competition different now in terms of just I guess, the types of people that you're up against, and more importantly, I guess, what people are really looking for out of these acquisitions? It's one thing if you're saying I'm running a company like XPO and I want to go buy another freight company. It's a whole nother thing for a private equity firm to come in and say, I want to do that same deal.
So there's two categories of buyers in general. There's sponsors, there's private equity guys, and there's strategics, there's corporations. That changes where you are in the cycle, depending on interest rates, depending on what's going on, depending on growth, just depending on how much money is in the. So it changes, and sometimes it's balanced. I would say it's more or less balanced now. I would say there's more emphasis on strategics in most industries, but not all, because interest rates are up. So for the sponsors who rely on leverage, that's a bad thing.
All right, Brad, we got to leave it there, but really enjoyed this conversation. Hope to see you again soon. That is Brad Jacobs, chairman of XPO and author of the upcoming book, How to Make a Few $billion. Now, still ahead on the close, 2023 is all about artificial intelligence, and Cloudflare is making moves to expand its global reach. Next, we'll speak to the analyst that says this could be a long-term tailwind for the platform. This is The Close on Bloomberg.
Thanks, Brad. All right, let's get a view from the sell side with our top calls, the big movers on the backup analyst recommendations. And we're going to start with On Holding. This is a Swiss footwear company, which actually just laid out a new 3-year outlook. It says it plans to double sales by 2026 and raise its adjusted EBITDA margin. Baird analyst Jonathan Komp reiterating his neutral rating and says the long-term targets should satisfy investors. Nevertheless, the share is down about 4% here on the day. Next up, let's take a look at Olaplex. Upgraded to equal weight over at Barclays, a price target of only $2 a share, but the analyst is optimistic here that the hair care company can stabilize its business regardless of slowing demand and some competition from other beauty brands out there. In the analyst's words, she says, the brand is not dead. Shares looking alive today, up 5%. And finally, Apple, an interesting downgrade today over at KeyBank, going to sector weight on the company, saying that U.S. sales are likely to struggle as consumers hold on to their older iPhone models. The analyst says Apple needs to re-accelerate its sales growth, and he also notes that the valuation on the stock has become a bit stretched. Shares, though, nevertheless, actually higher once again on the day, only fractionally, and those are some of our top calls. We do want to stay in the tech space now and take a look at Cloudflare and AI. Cloudflare is rolling out a number of partnerships with some of the top firms working with artificial intelligence. For more on this AI push, let's bring in Matthew Hedberg. He's RBC Capital Markets equity analyst. He has an outperform rating on Cloudflare. And Matthew, let's start off first here with these new partnerships. Give us a good explanation here of exactly what Cloudflare is trying to do.
Sure. Yeah. Thanks for having me. Really, it's in addition to a lot of the partnerships, as you mentioned, some of the leading vendors out there on the tech side, including Microsoft, NVIDIA, Meta, and others. They're really building out a much broader AI product platform play. A lot of these were announced with what they call their birthday week last week, and we think it's an important step in not only building product but also establishing key relationships with industry titans.
So when we talk about, I guess, how whatever cost is associated with this or effort, whatever you want to call it here, what is the payoff? I mean, going down this road, when do we start to see that actually show up in some material way in the actual fundamentals?
Sure. Yeah, I think, candidly, we wrote that we think some of these news from Cloudflare was bullish. From a positioning standpoint, candidly, we think it will take time to flow into the numbers. We think AI itself is a significant trend, similar to the mobile phone, the internet, cloud computing, and we think it's important for companies that can actually monetize it to be seen as potential winners from an AI perspective. And we think a lot of these announcements that Cloudflare announced are important steps in that direction, but like all things with a subscription model, it takes time to show up in actual numbers.
It takes time, and when you think about all the different partnerships that have been announced over this birthday week, if you will, Microsoft, NVIDIA, Meta, Databricks, Hugging Face, et cetera, which do you think will be the most long-term positive for Cloudflare?
I think the two big ones from my perspective are Microsoft and NVIDIA. Microsoft is clearly laying a lot of the groundwork with what they've done in generative AI, and NVIDIA is more of the rails that a lot of AI platforms are being built upon. We think having those two vendors as key strategic partners is an important step, I think, in not only providing a future roadmap for where Cloudflare is taking their own platform, but candidly showing to others with these partnerships that Cloudflare is a significant player in the space and a place where developers can not only build and deploy AI code, but really use it as a place to push the boundaries of where AI can take us in the future.
And I want to talk a little bit about your price target for the stock, $75. If you take a look at Cloudflare's longer-term chart, it hasn't seen that level in well over a year. Obviously, some of these partnerships, as you just discussed, they will take a while to actually show up in the numbers. But what is going to propel Cloudflare back to $75 over the next 12 months or so?
Yeah, I think, there's certainly a macro element to a lot of tech stocks these days. So that is certainly, I think, an important aspect of Cloudflare's stock. I think, too, though, showing that some of these new AI partnerships, some of their advancements in security, all set the stage for what we think is Cloudflare being a disruptive vendor in the future. And so it's giving some anecdotal evidence of traction with some of these new products. The biggest one that they announced last week was something called Workers AI, which is really a platform that's built with a lot of these partnerships in mind and really part of this broader monetization strategy.
All right, Matthew, great to catch up with you. Matthew Hedberg there over at RBC Capital. A look at Cloudflare here and some of the partnerships that it's been making, Katie Greifeld here, to expand into AI, or at least to take advantage of it here. And they're not alone here. I mean, you had Google, which is actually set to release a new version of its virtual assistant, the Bard. Which I'm not sure why it chose that name. Meta also rolling out, and then Canva, a design company, kind of helps you design sort of things for websites and stuff. They're also doing the same here. So this is quite a race going on out there right now.
Oh, big time, a total arms race. And it's hard to keep up with all of the different partnerships being announced, especially when it comes to Cloudflare. 5 different announcements on its birthday week. I do find that endearing. I also celebrate my birthday week, not just a day.
So you're one of those people. Okay. In all seriousness, I am curious, though, as to when we start to see a little bit more consolidation, because when you talk about partnerships and on things like that for just to get access to these tools, that's when you start, at least my brain goes into, okay, why don't these two just sort of get a room and just do it formally.
Especially when you think about how long it's going to take for some of these big AI pushes, these R&D spends to actually show up in a positive way on the balance sheet. Some of these companies, just to survive, might need to combine.
Do you employ AI in preparing for the show?
I don't. I'm curious if you do, though.
You'll never know.
Okay.
All right, a lot more coming up here on the big program. Tim Massad, the former CFTC chairman, is here to discuss the crypto fraud case against Sam Bankman-Fried and FTX and what it might mean for the future of regulation. This is The Close on Bloomberg.
Hello, Tim. It's David. Can you hear me?
I can, David.
Hi. Thanks so much for doing this.
My pleasure. Thank you for having me.
Romaine will be here in just a moment.
Okay.
And, we'll talk about the stuff we talked about yesterday, but take it wherever you want to take it.
Fine. Sounds good.
But I'll probably start out where I started with you yesterday, which is this is a standard fraud case, or is this a crypto case?
Right.
Right. And that just to set you up for where you want to go.
Yep. That's a great place to start.
You're up in Cambridge?
Oh, can I turn on my...
I am today, yeah.
Yeah?
Beautiful day up here. I had the window shade open, but it was too bright. So
It's a nice place up there.
It is.
Did you go to law school there?
I did. I went to college and law school.
I thought so.
So. And my son is in the college now. So that's...
Is that right? Oh, good for you. Good for him.
Do you have more travel coming up?
They still have the houses, right? Or no?
Yeah. Do you have more travel coming up, or are you staying?
We're actually going to Paris just for 2.5, 3 days this weekend to celebrate our anniversary. So yes, the answer is I have travel coming up.
Okay.
Oh, that's great. Well, I hope you'll eat well. I'll send you the name of a good restaurant.
Yeah, do. Romaine's here now. Tim Massad.
Hey, Tim. How you doing?
Hi, Romaine. How are you?
Hey, I'm good.
So I told him I was going to start with, is this a crypto case or is this a fraud case?
Okay, yeah, I overheard. Yeah, okay. I took a risk in turning my phone back on. Welcome back to The Close. It's time now for our Wall Street Week Daily segment with the host of Wall Street Week, David Weston, who joins us every day at this time. And I teased you yesterday, you were up at the Greenwich Economic Forum. You had a lot of great conversations, and I'm sure one of the big topics had to be what for some people is probably the trial of the century going on right now here in Manhattan.
Yeah, it is time for a Samuel Bankman-Fried fix, don't you think? We're going to be doing this, I think, for several weeks before we're done here. And so we thought we'd ask somebody who actually knows about this area terribly well, exactly what's going on from his perspective in the trial. Tim Massad is a fellow at Harvard's Kennedy School. He's the former chairman of the Commodities Future Trading Commission, and he really has written a lot on this subject. So thanks, Tim, for being with us. Let me start with the most basic question, because I hear it different ways. Is this a standard, ordinary securities fraud case, just involving a lot of money, or is it a crypto case?
Well, I think the government wants to argue that this is just a simple fraud case. This is about deception by Sam Bankman-Fried, lies, and fraud. And they want to stay away from complications about crypto and finance and regulation and which jurisdiction did things happen in. You know, they want to keep it as simple as possible. Whereas I think the defense will argue, look, Sam may have been sloppy, there was a lack of systems, he made mistakes, he screwed up, but they will hammer the point that there was not criminal intent here. At least that's what they'll try to prove. And obviously this is a criminal trial, you have to prove criminal intent. So I think that's where it starts, and we'll see, depending on how it goes, which side seems to be prevailing in terms of how they want to get the jury to think about the case.
Tim, what were the essential elements of the fraud, as you understand it? Because I've heard things like the misuse of customer money, using it for things that they didn't understand they were going to be used for. We also hear conflict of interest, things like that. Does that matter whether it's regulated under crypto or not?
Well, no, you can make an argument that it's fraud even without that regulation. But when you look at it, at the case, there are 5 charges here. And 2 of them actually pertain to Sam's relationships with investors and lenders. And then 2 are arguments about misuse of customer money, essentially. And then one is a money laundering charge. So on the customer money one, that one will be interesting because the defense may argue, look, the money, was either wired to Alameda originally, and maybe even they may argue that the customer agreements allowed FTX to loan the money out. I've heard that argument made, and it was interesting. They actually tried to bring in a witness, an English lawyer, to argue that that's what the contracts allowed. Judge Kaplan decided to rule that witness inadmissible because he said, look, questions of the law, of the applicable law, are up to me. But I think we'll see that argument be made, that there wasn't a fraud here on the customers because some of them agreed to let their money be used. To me, the bottom line here is it shows how weak regulation is. So even though this is not a trial about, the regulations, there's one thing that should be overwhelmingly clear as a result of this trial, which is the lack of regulation in this space and lack of protections for customer money. Well,
I'm curious, Tim, if that comes up in the courtroom, and even if it doesn't, we know it's certainly going to come up in the media and in the court of public appearances. We go back to previous fraud cases here, and we've seen this tactic before, the idea of, well, hey, yeah, maybe I did something wrong, but what about those folks in Washington who are supposed to be looking over my shoulder here? Are there any parallels to this case that we're seeing right now with SBF in court that you can recall?
Well, I don't know that I can recall a parallel that's on this scale. This one's pretty big. But I think you're right, Romaine. I think they will argue that, hey, look, we weren't that different from the rest of the industry. Now, whether that's true or not, we'll see in the evidence. But they'll point to the fact that this is an unregulated industry, and there arrangements where you might say, well, gee, that isn't really the best protection for investors, but there weren't specific standards that prevented it. Now, again, the government's going to argue this is basic fraud. There didn't need to be specific regulations. You told people, send us your money. You're going to be able to trade on FTX, and instead FTX used it to, make loans to Alameda, and Alameda then, made investments and so forth.
So Tim, given the fact that that lack of regulation looks like it'll figure both in the courtroom and outside the courtroom, will this trial likely lead to some regulation? Because you and I have been talking about this for a long time. They don't seem to be getting anywhere in Washington.
Yeah, well, I sure hope so, David. I mean, on the one hand, I would say the U.S. kind of missed the moment, sense that when FTX happened, you would have thought that might bring people together in Congress and say, okay, we really have to do something. We really have to strengthen regulation. But it didn't lead to that. And I think instead what happened was it reinforced people's pre-existing views. The people who were skeptical about this whole sector became even more skeptical, even more critical, and decided, boy, it really is worthless. That's what we thought all along. And the people who think there's some innovative potential here said, well, Sam Bankman-Fried was just a bad character, and he may have been guilty of fraud, but that doesn't taint the entire sector, so don't overregulate it. So we're still, at a place in the U.S., at least, where we lack a good regulatory framework. The SEC, of course, is bringing important enforcement cases, as is the CFTC, but I don't think that's enough to get us where we need to be. Other jurisdictions are moving forward with improving their regulatory frameworks. So I am hopeful that at the end of the day, this case might encourage our Congress to really come together and decide we really got to do something about this.
Yeah, Congress coming together is a notion in and of itself. Okay, thanks so much, Tim. Great to have you with us as former CFTC Chairman. Tomorrow we're going to be joined by Aaron Chatterjee. He's Duke University Professor of Economics about the state of the manufacturing sector in the auto strike. And on Fridays with Wall Street Week, we'll be joined by Glenn Hubbard, former Council of Economic Advisors Chairman, and special contributor Larry Summers of Harvard. That's Friday at 6 p.m. New York time.
All right, and of course you can catch David Weston every day right around this time, right here on The Close as we round out into the final hour of trading here on this Wednesday afternoon. Stocks have been oscillating between gains and losses for a good portion of the day. The yield story, not as much of a factor as it was yesterday here, but still a lot of concerns here about the read on the labor market and the read on the Fed. A big data point today ahead of what could be a big data point on Friday. Romaine Bostick and Katie Greifeld counting you down to the close. This is Bloomberg. Thanks, David. Almost 3 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Katie Greifeld.
An interesting day here in the markets, Katie. We talk about a market that actually did open higher, trying to reclaw, I guess, some of those losses from what was just a really dismal day prior to that here. But it's kind of been oscillating ever since. You're really not getting a lot of traction. There's a big question, and we had this conversation with Bill Gross, like, who wants to buy in a market, in an equity market, when you're not really getting a premium versus if you bought, say, in treasuries or something with a little bit less risk profile?
I guess if you really think that earnings are going to knock it out of the park, and certainly we've spoken to people who have a pretty optimistic view once those earnings season reports start rolling in. But I mean, it's a great point, especially when you consider how high yields are right now, not just day to day, but also if you go back, extend the chart out 15 years, we're at some pretty lofty levels, and that obviously impacts valuations.
Yeah, even with yields slightly lower here on the day, still well elevated here. And we should point out overnight, in the overnight session, that 30-year yield actually did trade above 5% here. You can see oil and gas stocks among the worst performers here on the day. As far as the best performers, a big part of the reason why you're seeing the NASDAQ higher is because a lot of those Magnificent Seven stocks are doing their job. But flip up the board here, Katie, because one thing that I was interested in here is this idea of the tightness in financial conditions. We know the Fed pays close attention to this. And we know that a lot of its jawboning has been because they want to keep those financial conditions somewhat anchored. And at least for right now, you can see that. Kind of hard to see on the far end of your screen there, but that's going into tighter territory.
If you squint, you can see a little bit of red. And of course, we know a lot of that comes back to what we're seeing in real yields, of course, at their highest levels in quite a while. But let's talk about
negative 0.0. I like that.
There you go.
I love the preciseness of the Bloomberg terminal.
I do, too. Yeah. I crave it in other areas of life. Let's talk about some individual movers. I want to start with Tesla. I don't have a good reason why Tesla is higher right now, but it is. It's up 5%. Of course, maybe some relief from higher interest rates, maybe a macro macroeconomic story going on right now. That's obviously helping to lift tech as well. But let's also move on, since I don't have a good reason there.
Okay.
Let's move swiftly along to talk about Intel.
Intel, do you have a reason for that? Because there was some news flow.
Story.
I think I remember seeing some news.
There's some fundamental news out of Intel. It reported plans to separate its programmable solutions group operations into a standalone business, sell shares to the public, or seek an investor for it. And the sell side is psyched. The sell side is psyched, not so much psyched about Ford. But when I saw those shares were lower by about 1% on the day. What's going on there? This story I found so interesting. So Ford electric F-150 pickup sales dropped 46% in the third quarter. Pretty amazing. Of course, that's their signature EV. Was that because Matt Miller pulled his order or something? Maybe. What happened? Basically, deliveries were delayed. It said it held back vehicles over quality checks, and that is translating into a bad day for Ford. So. Yeah, a bad day for Ford. And we should talk a little bit more about the automakers, because we are getting some of those production and delivery numbers not necessarily good here. We are less than 1 hour away from the closing bell here on this Wednesday afternoon. Our cross-platform coverage, counting it down to those bells, it starts right now.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. Romaine Bostick alongside Katie Greifeld. We're joined right now by our colleagues Carol Masser and Molly Smith. Molly filling in today for Tim Senovic. Welcome to our audiences across all of our Bloomberg platforms, television, radio, originals, and our partnership here with YouTube. Stocks on the back foot to a certain extent, Carol, though we should point out some of the big cap tech stocks doing the best that they can do. Katie Greifeld and I were just talking on the big program on television about some of the automakers. You saw Tesla higher, you saw Ford lower, GM also lower on the day as well, down about 2% here. And a lot of this seems to be because we're finally starting to get a tally of the costs from this auto workers strike. I'm so glad you went there. And I know you guys were talking about it a little bit earlier on television. GM setting up, a $6 billion line of credit, basically, to shore up their position, shore up their liquidity. I mean, basically, this has to do with the striking workers, the UAW striking workers. And as it goes on, those costs are starting to tally up. Right now, I think, Molly, already those costs to GM, we're talking about $200 million. Did you not give Molly the memo? I see blue, 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 and then black.
Yeah, no one told me.
It's all kind of lovely, isn't it?
On Wednesdays, we were blue, so.
I would say the mood is definitely blue at GM today. I mean, you're talking $200 million of sunk costs in 2 weeks already. I mean, that is brutal. So we're looking at, I think, talking to some credit analysts, they do say that this is the prudent thing to do for GM. This is already like a strong investment grade company. They've got a lot of liquidity to tap if they need to, but this could be a prolonged fight here. So it's really just getting ready for however long this may last. Yeah, and I'm also curious too about how it ends up affecting sales. We were just talking about the Ford F-150 Lightning and how some of those sales have dropped, obviously not necessarily related to the strike. Even though that's like the coolest looking truck, if we're being honest. Well, looks pretty good. Katie. Well, you need to do your part. It's time for you to upgrade. But they're a little pricey for my taste.
Did you guys see the story, though? You know what's really, really, really hot? Hybrids. Who knew among this EV craze?
Well, that's the thing. I mean, you want to do well for the environment, but there's range anxiety is real. So it makes sense
I don't want to
that,
spend money on that.
You go halfway. Maybe a hybrid makes sense for a lot of people.
Yeah. Well, actually, I'm in that camp. We were looking for cars, and we test drove all those EVs. And then at some point, you look at the cost differential with the hybrids, and you're like, I don't know.
They got to come down. They got to come down. Hey, it does feel like one of the themes of 2023 has been the strength of the unionized workforce.
Yeah, and to that point, let's talk about one of the big stories on the terminal today. Kaiser Permanente. Thank you, guys. They launched their largest ever U.S. healthcare strike. We're talking about more than 75,000 employees. God, it's a hard day.
Wednesdays do that to us. I don't know about it.
I know.
I'm just telling you.
In any case, they began striking on Wednesday morning. It's a 3-day strike, but even still, that could stall services for nearly 13 million people in at least half a dozen states. This is something we've been talking about really for months, that the strikes that we're seeing, it's an economy-wide issue. It's not something that's concentrated in any one industry, it feels like.
Yeah, and we've seen this, of course, as workers too. They looked at some some of the other unions and see what they've gotten, and everyone else sort of wants their piece of the pie. And we talk about this not just so much from the labor market perspective, but how that feeds over into the inflation discussion, right? The idea that if workers feel like they have the leverage to do this, in theory, that would mean, I guess there's some correlation with the idea that the labor market is still strong. And if so, that means wage growth might still be strong. And if that's so, then that means the Fed ain't cutting rates anytime soon.
Exactly, right? Wages tend to be sticky and last around longer. So higher for longer, maybe for the Fed, and inflation higher for longer as well. All right, guys, that's a wrap. We're going to continue this cross-platform coverage. That'll give Molly some time to change into a blue outfit. We'll see. All right, our cross-platform radio, TV, YouTube, and of course, Bloomberg Originals. Join us at 4 p.m. Wall Street time as we count you down to the close on this. Yes, it's Wednesday.
Welcome back to the close here on Bloomberg Television. We continue our coverage with those bells about 50 minutes away. We want to focus not on the markets right now, but on what's going on in Washington and beyond. A historic day in the U.S. Congress yesterday with Kevin McCarthy ousted from the speakership, the first time that's happened in our history. GOP hardliners revolted over the shutdown compromise. Take a listen as to what they had to say.
The yeas are 216. The nays are 210. The office of Speaker of the House of the United States House of Representatives is hereby declared vacant.
And McCarthy's removal fueling a lot of concerns about more turmoil in Washington. The House of Representatives is set to hold speaker elections next week, but keep in mind, we've got a potential government shutdown coming up here in mid-November if they're not able to reach a budget deal by then. Here to discuss this as well as other issues is the former U.S. Secretary of Commerce, Wilbur Ross, who's joining us live right now from the Greenwich Economic Forum. And Mr. Speaker, great to have you here on the program. And I do want to talk a little bit about the economy and more, I guess, the private sector. But I do want to get your reaction to what's going on in Washington. You had a front row seat to, I guess, how Washington operated and, more importantly, how it doesn't operate sometime. What do you make of sort of the evolution, if you will, since you've left office and what we're seeing today?
Right. Well, I don't think that Speaker McCarthy was really the problem. The problem is there are some groups within the Republican Party, especially in the House, that are very unhappy with Ukrainian spending, very unhappy with some of the welfare spending, and are very insistent that there be major changes. I think the scary part is the very fact that they're waiting till October 11th to pick a new speaker is bad, because we clearly aren't going to get any progress between the House and the Senate until there is a speaker. But then let's say there is one. It will most likely either be one of the fairly small group of very conservative people, in which case there's no reason to think that they'll be quick to compromise, or you might have a more moderate one, a Steve Scalise, someone of that sort. But it's not clear to me how Scalise or anyone like that would be able to solve the structural problem that there aren't enough votes that are willing to come to something similar to what the Senate is likely to pass.
I am curious.
I think you're going to have stalemate for a while, and I think the danger of a shutdown is much higher today than it was the day before yesterday.
What do you think maybe could actually provide some degree of compromise? We know there's an underlying issue here. Let's just set aside all the theatrics and politics that we know drove some of what we saw this week. There is a fundamental question here about our fiscal responsibility as a nation, our debt servicing costs, and what, if at all, we can trim in our budget going forward to address some of those issues. Is there anything that you see in there, in our budget, that could be, ample for some sort of common ground on both sides of the aisle?
Well, yeah, I think there are some things. For example, there's quite a lot of money that had been previously appropriated that hasn't been drawn down. If that would be frozen at the levels where it is, that would go some ways towards solving the problem without taking away from some of the new initiatives that they're wanting to have. There's still money left over from 2020, from the anti-pandemic moves that were made. It seems to me that trimming that, or it's just stopping it, would be a relatively easy fix, albeit it doesn't go the full way to where Representative Gates and some of the others would like this to be. But that's one area that I think would be relatively painless.
Let's talk a little bit more about the possibility of a government shutdown, because as you mentioned, of course, we're not going to get a new House Speaker immediately. And then, of course, we're coming up against that deadline in mid-November, at which point we could see the U.S. government shut down. We've had Moody's come out and warn explicitly about shutdown risk when it comes to the U.S. credit rating. How are you thinking about that? And does necessarily the U.S.'s credit rating really tie into what its creditworthiness actually is?
Well, I don't think the rating matters as much as investor attitude. No government ever really repays its debt. They all roll it over. So as long as the debt can be rolled over, it doesn't matter if you're AAA or AAA minus or AA or whatever. The real key is, will people continue to roll it? And about 1/3 of all the federal debt comes to be rolled over within the next 12 to 15 months. So that's around $11 trillion needs to be rolled over. If that gets rolled over satisfactorily, whatever the rating is, rating may influence the price of it. But personally, I don't think the rating is going to have too much to do with availability at this stage. Remember, they're not talking about making the U.S. Treasury a junk bond. They're talking about small gradations. So while it's a bad symbol, it's bad for morale, has bad longer-term implications, I don't think the immediate implications are particularly severe.
Well, to your point that it's investor perception that matters, and maybe a few notches on the rating system don't matter that much. When you think about the symbolism of it, do you worry at all that foreign investors might be less willing to buy our debt, of course, as the U.S. debt supply continues to go higher?
Well, the other problem is that not only will the interest rates be going up by a couple of hundred basis points on some $11 trillion next year, but also the money that the Federal Reserve had been paying over to Treasury. They pay over most of their profits to Treasury. Well, those profits are getting smaller because they're largely in fixed income, long-term bonds, and the shorter rates with which they're funding that are going up pretty rapidly. So there's going to be a lot of pressure, budgetary pressure, in any event at the federal level.
All right, have to leave it there. Really appreciate your time today. Our thanks to Wilbur Ross, former U.S. Secretary of Commerce. Now, coming up on the close, the defense for Sam Bankman-Fried says he didn't intend to defraud anyone, but prosecutors argue he stole billions of dollars from thousands of people. We'll have the latest on the trial.
Plus, we're going to have a sit down with Mandy Long, the CEO of the software firm BigBear.AI. You know it. And she has some insights on how using AI can actually help solve a lot of problems that a lot of companies are looking to address, including supply chain and cybersecurity issues.
And Swiss shoemaker On spells out ambitious growth plans, but shares fall with investors disappointed by the company's near-term guidance. We'll have the details. All that and more coming up. This is The Close on Bloomberg.
What are we doing to those shoes?
Time now for our Muni moment, and municipal bond trading volume has absolutely skyrocketed this week after benchmark yields surged to their highest in more than a decade. More than 70,000 trades were executed on Tuesday in the busiest day this year, according to data compiled by Bloomberg. For more insight, let's bring in Stephanie Larosiliere. She is head of municipal business strategies over at Invesco. And when you think about the type of the volume that we're starting to see, is there something fundamentally happening right now, or just has volume been kind of depressed the past few months?
Volume has certainly been depressed the last few months. We had a couple months there where, we had very slow trading days. September was one of those periods of time. But I really think right now we're looking at investors starting to take note of, as you mentioned, yields that we haven't seen in over a decade. I mean, every part of the curve is at a decade plus highs. And we're talking about a muni market where, in the past, when we have seen these yields, they've usually meant that there was some underlying fundamental questionable, credit issues. And that doesn't exist right now. So it's all about, getting the yield on a long-term basis, being able to either do that on an opportunistic basis or being a long-term investor. And I think that's what we're seeing is just the market taking note of that.
Well, Stephanie, I'm going through your notes and I'm getting excited because you write that the current period through late October may provide an attractive entry point. Why right now? Why is now the time to buy munis?
Yeah, so munis are a seasonal asset class. We had, a pretty strong technical during the summer where we tend to see very low issuance, and it's very simple. Bankers go on vacation and you don't have the deals coming to market, but you have a lot of coupons, a lot of calls, a lot of money getting reinvested into the market. September and October, and September was one of these months, are not months where we tend to have that money coming back into the market, but we do have a good amount of issuance. So it tends to result in a bit of weakness, price declines, and good entry points. Normally, November is a little mixed. Tends to be positive, and January historically has been pretty positive. So we see right now, and I would extend that into November, particularly because the Fed is at play here, could be really good times to take good entry points on a cost basis perspective that I think over the long term investors will be happy that they got in at these levels. I am curious too about,
we talk about some of the longer term economic conditions and how that could affect either new issuance or even to a certain extent in the secondary market. How much do you fret, if you will, for lack of a better word, about economic conditions? We pull our hair out every day over it for one reason or another.
It certainly matters, right? I think what we have seen, munis this year as well as last year, really couldn't withstand the brunt of what's been happening on a macro scale, right? I think the entire, bond market has been dealing with the exact same thing. So these things do matter. And but I would say in moments where, typical market environments, and I kind of do air quotes with typical, normally munis are not an asset class that will behave like everything else. We tend to provide really great diversification benefits. We tend to have very strong, tax-exempt income that we believe, continues to draw individual investors to our market. And so, on a go-forward basis, we do believe that we're going to see munis do a little bit more of that decoupling. Fundamentals at the muni level are strong. I've been listening to the show. We've been hearing a lot about, the dysfunctionality that is in Washington right now. In munis, we don't have that. In munis, we have states that are passing budgets. In munis, we have rainy day funds that are at all-time highs for 37 states. Fundamentals are strong and things are getting done and things are getting better. It's just that we really haven't been able to get out of the fray of the macro noise at this point in time.
And you're confident here. I understand your argument here with regards to states kind of being kind of on their own island to a certain extent, but you don't worry at all about what's going on with the federal government and how that could maybe impact municipal budgets?
So what's going on with the federal government? Certainly, we kick the can down the road. We've seen that we now have unprecedented times. There is an interim speaker, so we could see ourselves, I think, again in another situation where we have a government shutdown. The good thing about munis is, as I mentioned, those rainy day funds. We've been talking a lot about them here at Invesco, and the reason for that is because these funds can be used in any kind of situation where funds are short. So if we find ourselves in a position where we have certain types of municipal issuers that do rely on the federal government for appropriations, well, they can use the rainy day funds to supplement those until the government reopens. So we feel that it's a pretty good perspective in terms of where we are relative to the federal government at this point. We've got about 30 days where we feel pretty strongly that municipalities can continue to do well without having any issue related to the government shutdown, should that happen.
All right, Stephanie, a great conversation. Great to talk to you here. Stephanie Larosiliere, their Head of Municipal Business Strategies over at Invesco. Stick with us. We'll be back on The Close on Bloomberg.
Well, Swiss shoemaker On is laying out ambitious growth plans, looking to double sales by 2026. But the company isn't upgrading its near-term guidance, which is leaving investors wanting more for at least right now. And Romaine, this is an interesting company because like Hoka, like Brooks, it's one of those shoemakers that has managed to sort of eat into some of the territory that has been really ruled by Nike and Adidas.
Yeah, I'm actually fascinated by this. I mean, anytime you kind of have effectively what is kind of a new company come into a space that is dominated by such dominant players like Nike, you know, kind of has echoes of Under Armour, you know, I don't know, was it 20-something years ago when they kind of came out here. We'll see how long it takes. I'm not a runner, so you know these shoes much better than I do.
Yeah, I mean, I know a lot of people.
You're a Hoka person.
Yeah, I'm more of a Hoka gal, but I see them all around the city, so it's been interesting.
When you encounter somebody with different running shoes, is there like a face-off or something?
This is Bloomberg.
This is the countdown to the close. About 30 minutes left to go here in the trading day, Katie Greifeld.
And we're actually looking at accelerating gains on the S&P 500, currently about 0.7% higher. You take a look at the circle behind me. It's mostly green, more green than red, that's for sure. Consumer discretionary leading the charge. That sector up about 1.9%. Not classified, having a terrible day yesterday, but
we have to find out what's in that not classified
It's our
section.
mystery sector. We're going to figure it out. Communication services and tech also up more than 1%. You look at what's not doing too well. Utilities, of course, they had a pretty good day yesterday, but that has been under pressure for a while now. Currently unchanged. Energy off by 3.8%, Romaine.
Well, since you highlighted the 100% of not classified names moving higher, I'll start with 0% of the energy names moving higher here. At the bottom of your screen, Marathon Oil down about 6%. In fact, when you go through the S&P 500 today, most of the biggest percentage losers on the day are in the energy space. Of course, that will happen when you see a 5% drop in one day on WTI crude alone, adding to what has now been a string of losses after it has started to make that run towards $100 a barrel. Meanwhile, the flip side of that is keep an eye on the solar stocks. There was an interesting downgrade today on Sonova as well as Sunrun here, but Solar Edge seems to be bucking that trend. No real news here, but it does appear that there is a little bit of, I guess, arbitrage or pairs trades going on right now, if you will. Those shares up 4%. And Tesla, that's your biggest gainer on a percent basis in the S&P 500. Intel actually not having a bad day as well on the back of them actually saying they're going to separate one of their key units. I do want to talk a little bit here about the broader market here, and more importantly, where the returns are. And quite frankly, they're not anywhere. Not only did you lose money on equities in the month of September, but you also lost money on bonds and you lost money on a lot of other assets. In fact, that classic 60-40 portfolio, which had really started to come back in terms of the returns that it was delivering to investors, well, that's definitely been put on pause right now. Even though you have that negative correlation between yields and equity prices, but nevertheless, that's not enough to sort of deal with what we've been seeing right now as we head, we're still early, obviously, in October here, Katie, but as we head into this next month right now, concerns that those losses on a dual basis might continue.
Well, let's talk about AI, because when it comes to the stock market, obviously AI, one of the hottest topics for investors right now. And shares of the software company BigBear.AI Holdings are up about 100% so far this year. And of course, Big Bear, it focuses on using AI to help customers solve challenges involving supply chains, enterprise operations, cybersecurity, and more. And I'm thrilled to say that joining us now is Mandy Long. She is the CEO of BigBear.AI Holdings. And Mandy, tell us a little bit about the customer base at this point. I know that you have exposure to defense, et cetera, but how are you thinking about some of your commercial exposure as well?
First of all, thank you for having me, and I appreciate the opportunity to be on. Our customer base at Big Bear is diverse. We historically came up as predominantly operating in the defense world, as you said, representing over 20 government agencies, both on the defense and the intelligence side. But the piece that I think is really starting to unlock now, particularly as you think about what's happening in the global supply chain and the disruption that we're seeing there, is the commercial side of our business, which has been focused on manufacturing, logistics, warehouse operations, and how to do large-scale discrete event simulation to help with basically the determination of best next step. And in a world that is seeing the level of change and disruption that we're seeing now, we're seeing more demand than ever for our solutions.
And when you think about the push into the commercial side, do you anticipate that you're going to need to raise capital? You take a look at some of the sell side reception of the stock. It was TD Cowen that anticipated that by late fiscal 2024, you could need more capital.
So I actually do not anticipate that at this point. We've spoken a lot about it, not only with analysts, but more broadly in the market associated with the decisions that we made this year. We raised capital in a market that really wasn't giving it, which I think is a testament to the quality of the fundamentals of the business that exist today. And when we look forward, in the second half of this year, we're getting to a place where we're operating cash flow positive, and we see a very positive outlook as we begin to see accelerated growth.
There's been a lot of talk, of course, about the idea of sort of how you sort of set up guardrails, if you will, around the use of artificial intelligence. Obviously, there's been a lot of extreme predictions, both on the negative and the positive side as to what AI can do. I'm wondering if you can just give us, I guess, a more practical application of it, because we talk to so many companies that aren't AI companies, just regular old companies, and they talk about how they've been using some form of AI, it may not necessarily be called that, but some form or another of that for years now.
Sure. I think AI comes in many forms. I think one of the great things that I spend a lot of time educating not only our customers, but when we talk to the broader community about artificial intelligence and machine learning is that it's a tool. It's an extraordinarily powerful tool, particularly with what we're seeing in the rapid acceleration and availability of high-powered compute that can be paired with that. But some of the most powerful applications of AI are going to be in what unlocks, as many have spoken about, the fourth industrial revolution, changing the way that people live and work. And if we apply that to even what we started this discussion with in supply chain, there are very important decisions that need to be made that affect many downstream consumers where AI can play a role, whether it's in purchasing forecasting as it relates to commodity goods or manufacturing optimization on the floor, all the way down through inventory management and distribution. There are places where practical use of AI, right? So, kind of unpacking that, it's, math on steroids, right? Being able to apply that to use cases where pattern recognition is highly relevant, where human cognition, right, has limits, right, associated with how much information we can take at a time. That's the spot for AI.
And there's also another component of this, and we were having a conversation with Jana Eggers, kind of a real pioneer in this space a couple months ago. This idea, too, of how this data is used, and more importantly, how it's presented. And there's been this discussion about this idea that if you just put the data in front of me, there's a certain task in that's going to be hard for me to sort of decipher what I should do. If you make that data visual, and let's face it, we all love pictures, it makes it a little bit easier to interpret where, say, the problems are and how to solve those problems.
So what you just touched on is, as a technologist, the thing that I consider the holy grail, right, which is vision AI. It's the ultimate shortcut to context. And what that really means, right, is that as humans, right, we process visual information 60,000 times faster than text, right? It's easier to remember. And half of our brain, the brain power that we have today, is directly or indirectly devoted to processing visual data. So when we think about the power of applying vision AI, right, the idea of being able to replicate eyeballs, making that a lot easier, that's something where I think you really start to undo some of the challenges that we're faced with as we look at what is ultimately having to mine big data landfills. When I look at where we're investing and where we're spending a lot of time, the application of vision AI to workflows is really a big unlocker to move the ball forward in dealing with what are incredibly challenging, some say data lakes, I say data landfills, associated with actually building those models effectively.
All right, Mandy, got to leave it there. Really enjoyed this conversation. Our thanks to Mandy Long. She is Chief Executive Officer of BigBear.AI Holdings. Now, coming up on the close, Cal-Maine shares down after the release of their first quarter results. It's our stock of the hour coming up next. This is The Close on Bloomberg.
right, it's time now for our stock of the hour. A look at Cal-Maine Foods. The share's down today after its first quarter report missed estimates. That's even with as egg prices actually return to normal levels. Joining us right now is Michael Hertzer in our Chicago bureau, who covers food and agriculture for us here at Bloomberg. And let's just get out of the way sort of why we're seeing this reaction, because I was going through some of the numbers here, Michael, and it was pretty dramatic here. When you look at the drop in EPS, the fact that it missed, when you look at the drop in sales, when you look at the decline that we've seen in average selling prices here, we should point that this is all coming down from what I think most people thought was a fairly artificial level last year when egg prices went through the roof.
Yeah, for sure. I mean, things are coming down, and I guess what investors are probably keying in on is, when does it get better? Cal-Maine in their earnings release said that conventional egg demand is still strong. They're seeing less demand for specialty eggs like organic. So it's just kind of like, when does things start to improve, and when do these lower egg prices really start to, I guess, get people to start stocking up?
I'm glad you specified that specialty eggs mean organic, because I was wondering what a specialty egg is, what a conventional egg is. And let's talk a little bit about the actual chickens, because my understanding of why we saw egg prices really get out of control over the last year or so is the bird flu outbreak. Where are we on that story?
Cal-Maine mentioned that, they still have not really been impacted themselves as a company with any infections. In the U.S., there has been a dramatic drop in infections. It's still the worst outbreak ever. It's spreading, recently popping up in South Africa, in Brazil, and even in France. They're starting to vaccinate some ducks, which is kind of creating a whole new trade barrier to sort of bring in some like foie gras into the U.S. But for Cal-Maine, they are still doing a lot of biosecurity measures to protect their farms and keep bird flu out, so they have higher costs. But overall, the laying hen population is rebounded in a pretty big way. So there's lots of more chickens hatching eggs.
Interesting here. So we're going to be all set for the holiday season, at least for those of us who like eggs, who eat eggs. We don't really eat eggs in our household. My son hates eggs, but I'm asking for the people, Michael.
Yeah, I mean, if you look at like the USDA chart, it's just over $2 a dozen eggs, so it's like less than half of the record from back in January, when millions of birds were being put down to stop the spread of bird flu. So there should be ample eggs as we start to get into baking season.
That's good news, because actually Romaine was asking for me, because I eat eggs. And I want to talk a little bit more about Cal-Maine's results and the egg market overall. So now that we've got the supply side maybe sorted out here or coming back to normal, what does the demand for eggs look like from people who aren't me?
Yeah, Cal-Maine highlighting the main things they're highlighting in the release were bird flu and inflation. So, as people continue to deal with inflation and, trade down on the type of meat or produce or eggs they're buying. So maybe if we start to see people going back to organic eggs and saying, hey, I'm willing to pay that premium, that might sort of put together a bigger rebound in the market.
All right, Michael Hertzer there. A look at Cal-Maine having one of its worst days, the stock having one of its worst days going back to April, on some big misses here in their latest earnings report. And Katie Greifeld, I mean, it's not just eggs. We're going to get Lamb Weston results tomorrow. It's potatoes.
Right.
And the big ConAgra is supposed to come out as well here. So we're going to get a read here on a lot of food staples.
You know what goes really well with eggs?
No.
Potatoes.
Wow. It's a nice little segue there,
Anyway.
Katie Greifeld. How long did it take you to come up with that?
Actually, about 2 seconds after you said it.
All right, we're going to say goodbye to Katie Greifeld. In a minute, we're going to say hello to Carin Pei, Fiduciary Trust International Executive Vice President. This is Bloomberg. This is the countdown to the close. I'm Romaine Bostick. Joining me right now, as she does every day at this time, is Scarlet Fu. And Scarlet, we talk about a market that's kind of been all over the place today. We had a pretty strong open, and I think we kind of lost some of that momentum a couple hours ago. But last time I checked, about 10 minutes ago, we were at session highs.
Yeah, just about, with the Nasdaq up 1.25%. The S&P 500 got close to its 200-day moving average, but that support level ultimately held. And you wonder, yesterday we had good news that was interpreted as bad news for the market. Today we had bad news on the economic front, interpreted as good news for the market. So I'm not sure which one is more representative of what's to come.
I'm not so sure either, and I do wonder how much today's price action in the equity market is tied to what we're seeing in the rate space. Of course, rates down here on the day. Of course, I don't think anyone thinks that upper client has been arrested, but at least for today, that's put on pause. And also the fact that you had a real big downdraft today in oil. I mean, WTI down 5%.
Yeah, and that's a big question mark there as well. Gasoline inventories rose while demand dropped to 25-year lows, especially for gasoline, but no one's saying that this is the end of the rise in oil prices either. All
right, let's get some insights out of our next guest to help us count this down to these closing bells. Carin joining us, Fiduciary Trust International Executive Vice President and the head of portfolio management over there. Great to have you here in the studio.
Thank you so much.
Let's start off with the good news, bad news narrative here, because we did kind of see that, I think, with the jobs data we got yesterday with JOLTS, and then the jobs data we got today when it comes to the ADP private payrolls numbers. The idea that this is a market that does seem to be trying to find some sort of ratification that there is softness in the labor market, and as a result, softness in inflation.
Yes.
Yeah.
So I think definitely continuing the trend in terms of the market looking to the Fed and looking to the direction of rates as a guide for equities. And certainly we've seen the bond market sort of driving markets of late with the rise in 10-year yields really putting pressure on equities recently. So the markets today, I think, are reflecting the fact that, well, we've got some sort of weaker employment data, and that suggests that maybe the Fed will need to take action. Maybe that, the perception that the market has that we're going to see higher for longer sort of gave people a little bit of hope that maybe we have a little bit of a reprieve there.
I'm curious, everyone is so focused on this idea of when the Fed cuts, right, and that will provide a tailwind for stocks and other risk assets. I'm curious about the conversations that you have internally with your peers as well as with clients as well about this idea of higher for longer. That can you live in that environment, meaning can you make money in that environment? Is it, having a 5% baseline on the Fed funds rate, is that really the worst case scenario?
Yeah, so actually we just talked about it this morning in our meeting about how this market environment is actually giving investors sort of a three-legged prong in terms of an investment strategy with equities, fixed income, as well as cash and alternatives. So I think that, for the first time in a long time, we do have some alternative to equities, right? As we've seen over the last several months, there is some yield opportunity in fixed income. And I do think that with valuations on equities where they are, it makes sense for us to be and to remain a little underweight on equities and look for, some opportunities in fixed income. So we remain overweight fixed income at this point. We do see the yield opportunity there. We're actually considering potentially extending some duration, but not quite yet. It just seems as though there's a little bit of pressure on the upward side on rates. So we want to see how that settles out.
Yeah, so is there something specific you're looking for before you make that move and increase your allocation even more to fixed income?
So I think we're looking for some stability in terms of the upward price, yield pressure right here. And, I think that certainly when it comes to fixed income, right now we're still underweight duration slightly, but we're looking to extend it to more neutral to try to capture some yield opportunity. If we can get a 4.8% on the 10-year bond, certainly a lot more attractive than where it was 6 months ago.
Well, we're in October. October is notoriously volatile, so anything could happen in the next couple of days or weeks. We know that earnings season is right around the corner next week, and there was no regional banking stresses in the third quarter. Jamie Dimon, the CEO of JPMorgan Chase, has made clear the health of the consumer and of businesses is in good shape. What is your confidence in the banking sector's ability to weather the impact of these surging bond yields and surging yields overall?
Yes, so definitely more recently we started to see a little bit more pressure on bank stocks given the rise in rates. So I think a lot of the bank stocks, it really does come down to kind of the health of the consumer. Consumer lending has been a big driver for growth for the banks. I think we're going to continue to see a relatively weaker loan growth environment. So we're not yet optimistic, or we haven't been positive on the banks. We do think that in this most recent quarter, the consumer spending numbers got a boost from some temporary factors. It was a really, really popular sort of summer for concerts, so that provided a lift.
I hadn't heard. Is there anyone?
In terms of Taylor Swift and Beyonce, helping out the economy.
Yeah.
So, but we think some of those tailwinds will probably fade, and consumer spending probably will start to slow down again. And therefore, with that kind of backdrop, it's hard for us to be positive on the banks. And we do think that some of the pressures around balance sheets and also around mark-to-market losses on the bonds that financial institutions hold probably may come back to bite the banks.
I'm curious on the consumer spending side, if we are seeing that softness, and it does appear that that's there here. The flip side of that everyone is also concerned about is the potential for delinquencies and defaults and things like that. And we know right now the data seems to show that's relatively contained, at least on a historical basis. Does that worry you at all that we could start to see an uptick in those numbers?
It is definitely something that we've got our eyes on and that we're monitoring because, as you mentioned, relatively speaking, historically speaking, they're still at low levels, but they are inching up and delinquencies are rising. I think if you look in the subprime area, or also if you look at the smaller regional banks, the delinquency rates are much worse there. Mm-hmm. So that is an area that I think could potentially be signs of stress in terms of the financial markets and the economy.
All right, Carin, this is great to talk to you and great to have you here in studio. Carin Pay there over at Fiduciary Trust, stopping by today to help us count down to these closing bells. And Scarlett, we talk about, I guess, what the setup is going into Friday. Of course, we get a big jobs number. Of course, we know we're going to get it because at least the government's open. And I wonder if that's going to change the narrative at all, no matter what we get.
Is the default scenario still a soft landing or no landing?
I feel like that's the hope, right?
Yeah.
I don't know. I mean,
the Fed seems to have really glommed onto that idea.
Right, and we heard that from Romaine Bostick yesterday. I don't think he used those words, but he was basically describing a soft landing, more or less.
Yeah, but I mean, with what we're seeing in the coming weeks and months coming up, it's going to be a big question mark. I also wonder how much Washington dysfunction may dampen sentiment. Yeah.
Dysfunction in Washington? I hadn't heard. All right, guys, we are moving closer to the closing bell. Stick with us. Romaine Bostick here alongside Scarlet Fu. Our full micro coverage, counting you down to those closing bells right here on Bloomberg as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Scarlet Fu. We're counting you down to the closing bell and here to help take us beyond the bell. It's a global simulcast with our friends Carol Massar and Molly Smith. Welcome to our audiences across our Bloomberg platforms. You are always my friend, Carol, no matter how hard I am on you. You know, they told me yesterday I was talking over you and all this. I said, really?
I went back and
looked at the tape and I said, this is just a normal day for us.
It is a normal day. This is not a normal day, though, in trading, right? I just feel like, again, it's another day where we see almost 2 different days of trends. And here we have the large cap tech names. I'm looking at Microsoft, up about 2%, Amazon, Alphabet, all up about 2%. You know, just when everybody says, forget about big tech, once again, investors coming in and buying on any kind of dip, Molly.
Oh, I was looking at the ones that were dipping today, and this is more in the energy sector. So take a look over at some of the refineries today. I was looking at Phillips 66, at Marathon Petroleum, and Valero Energy. All those dropping today as the EIA data showed that gasoline demand is falling and oil prices also extending their slump on the day.
Yeah, it's really interesting what's been going on with those energy names in particular. You look at the big movers of the day, they were all energy names and those big tech names. It's kind of like an either-or market right now.
Yeah, it is an either or now. And it gets to the question is, are you buying into a fundamental story? Are you buying into a macroeconomic story? Or maybe, I don't know, something that's just completely divorced from all of that. But look at the data that we got this morning, guys. What does that tell you about economic conditions? And what's the setup then as we head into Friday? We got an awful day yesterday, but clawing back some of those losses here on this Wednesday afternoon. So a bit of a reprieve here. To be sure, the Dow Jones Industrial Average looks like it's going to finish out the day higher by more than 100 points, up about 0.4%. The S&P 500, which yesterday was flirting with a break below the 200-day moving average, now trying to create some distance between the two, higher by about 34 points or 0.8%, while the Nasdaq is going to close higher by 1.4%. And let's check in on the Russell 2000 because the cyclical trade had started to gain a little bit of steam. You did not necessarily see that today. The Russell is your relative laggard on the day, only higher by by about 0.1%.
All right, so let's dig a little bit deeper, into the S&P 500, and probably looked a lot different certainly earlier today. But right now, Scarlett, you've got almost 377 names to the upside in the S&P 500, 125 to the downside. The S&P 500, which is skimming along that oversold RSI level, as soon as it hits it, it just kicks to the upside. You find buyers coming in.
Yeah, and we close near our highs. It's notable that the last 35 minutes of trading or so, it feels like it was a straight line up. When you look at the sector breakdown, just 30 minutes ago, this was pretty mixed. At least at midday, it was definitely flirting with a lot more red. In the end, you have autos and components, software and services, and media entertainment all gaining at least 1.5%. Look at autos, up 5% as a group. And then on the downside, energy stocks lower by more than 3%, telecom stocks, utilities. So you have energy falling with gasoline prices and oil prices, as Molly mentioned earlier, but utilities and telecoms, those are your bond proxies.
It's like everything is awesome, right? Again, I don't know. It's kind of crazy. All right, so let's get to some of the individual gainers in today's session. Check it out, everybody. Tesla, top in the S&P 500 and the NASDAQ 100, up another 6% in today's session. It did trade lower earlier in the week, right? There were some concerns about weak production and delivery numbers. That put some pressure. I really would look for anything kind of specific. The EU is formally launching an anti-subsidies probe into EVs made in China. Does that possibly help or hurt Tesla? I don't know. There's another report noting that Tesla taking its Cybertruck testing to Mexico. Also, it's being seen in Ohio, Florida. So maybe there's some excitement over that. I couldn't find a real catalyst, but nonetheless, investors certainly did, enough so that they were buying into Tesla. And then check out the cruise lines, guys. It wasn't so good yesterday when you had Morgan Stanley cutting price and estimate targets on the big three cruise liners. They were under pressure yesterday. Investors coming back in. Shore Capital stockbrokers, analyst Greg Johnson raising the recommendation on Carnival to hold from sell. Carnival up 2.7%. And don't forget, too, those falling oil prices, which is a big cost line on the balance sheet for the big cruise companies. That coming down, maybe helping them. And so you also had, check it out, Norwegian, it was up in today's session. Royal Caribbean up about 3%. Norwegian up almost 4%, Molly, in today's trade. And you're looking at the energy names, right?
I am. So like you said, maybe those is a good sign for the cruise lines, but not so good if you are in the oil business. So today, oil plunged most in more than a year, a signs that demand is flagging in this high rate environment as we're really gearing up here for this higher for longer stretch in interest rates. So West Texas Intermediate crude settled below $85 a barrel today. It's the biggest one-day drop since last year. So the bigger decliners today is Valero Energy, Marathon Petroleum, and Phillips 66. All of those down more than 3% on the day.
Let's take a look at what happened in the yield space here, because we talk about that relentless climb higher in yields, actually taking most of the Treasury market into oversold conditions here as that sell-off really looked like it was going to extend for a fifth week. So a bit of a reprieve here on the day as the entire curve shifting lower. Most of the activity on the longer end of the curve with the 2-year down about 10%. And on the longer end, you're seeing a drop of about 6 basis points or so on the 30-year. We should point out, though, overnight, there was a lot of volatility, and that 30-year yield did actually trade above 5% for the first time in quite a few years. And I am curious, guys, about your thoughts here about the direction of yields. It's interesting. We're speaking with Bill Gross a little bit earlier, and he really was hammering home this idea of how the Treasury market is in oversold conditions, and that, at least on a technical level, might actually provide somewhat of a reprieve. But of course, he's still in that camp that yields are destined to move higher from where they are right now.
They can be oversold for a really long time. It's not clear what the catalyst is for that to correct itself. And of course, it was the jobs-related data that really sparked these big moves yesterday, and of course today. And tomorrow we'll get jobless claims, which a lot of people are saying is the number that they're keyed in on because it's high-frequency data. It comes out on a weekly basis as opposed to a monthly basis.
Yeah, 210,000 is what we're looking for. 204,000 was the previous month, or previous week, excuse me. And I do think it is a market that continues to move, I feel like, in a big way swing in terms of the data points and the data points that really matter to the Federal Reserve. And I think we see that certainly play out. So it'll be interesting to see what we get tomorrow. And then, of course, on Friday with that monthly jobs report, which is old data, backward looking. But nonetheless, it certainly can set a tone in the marketplace.
Yeah, that's definitely going going to be the biggest one that we get this week. And of course, so many of us didn't think we were going to get that report this week. Remember, we were bracing for a shutdown not too long ago. So nice little surprise that we will get the payrolls report. Looking for a little bit of a moderation there. But I've been hearing, I don't know if you guys as well, for some more people calling for more the 100,000 level in payrolls gains. And that would really be starting to signal a steeper drop off from where we've been.
All right, well, hold out hope, Molly, because don't forget, we have to go through this whole budget debacle one more time in November. So it's possible we could get a shutdown.
Romaine. They're going to figure it out over the weekend, and it's going to be smooth sailing.
Yeah, don't get me riled up here, Carol. On that point, though, I thought it was interesting because there was a lot of questions. I know we posed a lot of questions to our guests here about the impact on government finances from this debacle and just the overall dysfunction. And Fitch Ratings actually did come out and kind of make it clear that the downgrade they did earlier already sort of takes into account all the mess that we're in right now, basically saying that the reasons why they downgraded were exactly the reasons why we ended up with McCarthy being booted out, which is that, quite frankly, you do have a dysfunctional Congress, and at least in the House, a Congress that is kind of beholden right now to a very small minority of members who just kind of want to see the world burn.
You know, Brett Jacobs, who you guys also had on, executive chair over at XPO. I love logistics. I love trucking. It tells us so much.
We had him on first.
No, okay, but we did it better. But anyway, he had such a great perspective kind of on the world. And in terms of Washington, he's like, yeah, we watch it, but so great that we actually have a government, two parties, two different sides. And ultimately, it does function versus, do you go to a country where it's really one leader who just calls all the shots? And he talked specifically about...
we call those aren't democracies, Carol. Can you compare our democracy to other democracies? You're comparing our democracy to a dictatorship?
Well, basically...
This is a glass half full perspective.
I don't know where you're going with this, Carol.
Basically saying that it is much better than a dictatorship, right? That we do actually have some level of functionality.
Okay.
Some level.
Now, I lost my train of thought.
No, I think you can end it there. We have some level of functionality.
No, please let her keep digging.
The other thing that was interesting that he pointed out, that when we look at the economy, he talked about these stimulus programs, whether it's infrastructure spending, these legislative things that actually did get done in Washington. See, it does function occasionally. In that is going to provide a level of liquidity to the economy. And I thought that was an interesting highlight that he brought out.
Yeah, there's that. And then you hear about other investors saying they actually want gridlock. They don't want any new spending plans. They don't want anything being done because the way it is right now makes it predictable. But at the same time, I can't imagine that expectations of paralysis and constant threats of shutdowns or possible defaults is a tailwind for the markets in any way.
Yeah, it kind of makes me wonder, going back to that Fitch downgrade, I mean, what was in their crystal ball then? I mean, I guess it's maybe not so surprising. You look at the 10 months McCarthy had coming into this showdown here, obviously a tumultuous vote to get him into the speaker seat to begin with, the debt ceiling we had back in May. So who knows, maybe this is his little hat trick of sorts.
I feel scarred. I'm just going to tell you, Romaine, I feel scarred.
Don't worry, you're fine.
Yeah.
You got no issues with your Congress people out there in New Jersey, right? They're all squeaky clean.
No comment. All right, we got to run.
We'll leave it at that.
We could talk hours about that off camera.
Right,
all right.
Did I touch a nerve?
No, please. It's part of our history, unfortunately. All right, that's a wrap. Our cross-platform
coverage. Just don't ask me about Chicago.
That's right. Yeah, see, we can talk about that together. Radio, TV, YouTube, and of course, Bloomberg Originals. Guys, join us tomorrow. Our conversation will continue.
All right, stick with us. A lot more coverage coming up here on The Close on Bloomberg. A discussion here about bankruptcies, restructuring in the retail space. That conversation coming up in just a bit, and a little bit later on the program, we're going to hear from Senator Richard Blumenthal and get his thoughts, of course, on what's been going on in Washington here, right here on The Close. This is Bloomberg. All right, welcome back to The Close. Another wild day in markets here. It was to the upside here for U.S. equities. Actually, a relatively strong showing, a relatively broad-based rally, but nevertheless here, this has still been one dominated by the Magnificent Seven. The big cap tech stocks did what they were intended to do here, but that is actually a big part of the concern right now. A white line and the blue line, what you're seeing there is the S&P 500 versus an equal-weighted version of the S&P 500, and it shows you just how much of an outsized impact those big cap tech stocks are having. And the reason why a lot of folks really want to see a broadening out of this rally before they come off the sidelines and try to bite the bait. Amazon, Microsoft, Tesla doing their job as it was intended to do. Tesla having one of its best days in a while. In fact, the biggest percent per gainer right now in the S&P 500 on the day. Meanwhile, it was energy stocks to the downside. In fact, of the top 10 decliners, most of them were in the oil and gas space. Exxon indicative of that. But you actually saw a lot of the refiners, as well as a lot of the oil field services companies, really take it on the chin as well. A 5% downdraft in WTI crude, partly responsible for that. But ultimately, what this comes down to for investors is trying to pick and choose the asset classes that not only are going to provide you a return, but provide it on a risk-adjusted basis. And one of the big cases against stocks over the last few weeks and months has been the evaporation of the equity risk premium. This is basically what you get, the earnings yield that you're expected to get here relative to what you would get by just buying and holding treasuries. And that gap has narrowed to effectively zero right now, 0.4039 there on your screen right now. We'll just call that zero. And if you don't necessarily have that breathing room between what you're getting in the treasury space and that earnings yield that you're getting in equity markets, you're going to have a hard case going to your clients, going to your investment committees, and making a case to buy more equities. Scarlett?
Very well said. And that's a great context here as we continue our conversation and look at the outlook for debt restructurings and bankruptcies in the retail space. Joining us now is Holly Etlin. She is partner and managing director at AlixPartners. Holly recently served as interim CFO and chief restructuring officer at Bed Bath & Beyond, which is a client of AlixPartners. Holly, so good to see you.
So nice to see you guys again.
So the backdrop here, of course, is higher for longer interest rates. Howard Marks recently told David Rubenstein that companies don't go bankrupt because they keep losing money. They go under because they borrow money, and when times get tough, they have trouble refinancing those loans. Are retailers significantly more leveraged this time around than in previous cycles?
You know, I think they are probably as leveraged as they've been in any cycle. I wouldn't say they're extremely more leveraged, but you know, with the higher interest rate environment and a little bit more conservative lending environment, people who need to extend or refinance are seeing a little bit more bumpy road than they have in the past.
I mean, we were just talking the other day about the bankruptcy filing by a Smile Direct Club. There's been a couple other companies that did very well, and when you look at the filings, still had relatively decent revenue or revenue growth or to look at here. But this idea of a fiscal cliff, what is the phrase I'm looking for, where they do have to kind of come back into the market, either refinance or get new financing here. And I'm curious as to what the options are going to be. If we're stuck at 5% as a baseline for interest rates for the foreseeable future here, what hope does that give some of these companies?
Well, I think the lenders are being much more conservative on their underwriting. So, for example, if I've got an existing ABL facility with you, you may be looking at enhancements to your position, not necessarily in the form of interest rates, but maybe in the form of other kinds of restrictions and reserves that net may make me able to borrow less. And so people are trying to really take their credit position and make it a bit better as part of these amendments and, redating on revolvers, those kinds of things.
There's also the question here as to whether some of these companies sort of try to preempt some of this, basically try to find a white knight, if you will. The other day we were talking about Chico's and its sale to Sycamore Partners, and I'm wondering if we could maybe anticipate seeing more of that for some of those companies that do have decent brands and relatively decent business, but maybe just got behind the 8 ball with regards to their debt.
Well, Stefan is a smart investor. So I think so. But again, when you're looking at an investor, they're coming in behind any debt that there is. And so they're going to be looking at the current lenders to see what kind of deal they can get in the form of extensions or PIK interest or whatever that makes it worth them coming in that slot.
Romaine mentioned branding. Within retail, how important is the brand and the loyalty it generates to a successful turnaround and its ability to survive as a business?
Well, we're seeing increasingly sort of a tale of two cities. There are the brands that really matter, and then there's everybody else. And if you don't have a real following, then it's about Do you have availability of product? Do you have a price point? Are you convenient to shop? Those take precedence over the appeal of the brand. Everybody would love to have that brand that drives the customer, but not everybody's going to have that kind of brand.
So let me put that question to you in the context of Bed Bath & Beyond. It filed for bankruptcy this year, no longer exists as a company, sold its IP to Overstock for, what, $21.5 million. Overstock has now rebranded itself as Bed Bath & Beyond online without any physical stores. How much of this transaction, this relationship, do consumers understand when they go to that website? Does it even matter at this point?
I don't think it matters that much. Overstock really had a huge challenge in that their business was not an Overstock business. Their business was an everyday great pricing business that many consumers wouldn't shop. And they had been looking for a new name for an extended period of time. And then they got this opportunity to buy this iconic brand name and rebrand themselves.
And it'll be interesting to see, I guess, how much that sticks. I mean, how much people sort of follow these brand names to where they are. I am curious, though, about this idea of sort of the lessons that have been learned or maybe not learned coming out of the pandemic, where these companies were really sort of put to the test, having to shut down their business, at least their physical businesses, for a while, shift to online. A lot of companies were behind the curve on that. Do you think that now, 3 or 4 years removed from the start of the pandemic, that those lessons have been learned?
Well, I can only say that the majority of the projects we're doing are all around sharpening their logistics pencils, making sure that they're more resilient to the kinds of disruptions that we saw during the pandemic, really looking at diversifying their vendor base away from Asia so that they have some balance structurally in the world. So those are all as a result of those lessons. And the smart retailers are all doing all of that and more. They're also taking a very heavy look in this consumer debt environment at their cost structure, their SG&A cost structure. They're really trying to get ahead of that. They're seeing softness in the market already, and they want to make sure that they're doing what they need to do to bolster their earnings.
But what there is to cut? I know it's sort of different for individual companies, but it's not just cutting people, because a lot of these companies are already working with a relatively thin workforce here. So what is it, scaling back advertising, marketing? Is there, I mean, what's there to cut?
It's just all the other structural costs of the business, being more efficient and effective. You know, we've seen freight rates, domestic freight rates are down 20 to 30% for trucks in the U.S., and ocean carrier rates are down almost 80% from last year. So, but the key is trying to then lock those in so that you don't just, you're not exposed to the same degree of fluctuation that people were during the pandemic, and really making sure that you can lock in those savings going forward with more structurally secure arrangements with your vendors.
Holly, this was a great conversation. Great to see you once again. Holly Etlin there. She's a partner and managing director over at AlixPartners. I want to bring you some breaking news. This is on Clorox. Shares down in after hours trading here by more than 4% here. The company is saying that its first quarter numbers, its fiscal first quarter numbers for the quarter that just ended at the end of September aren't going to be good here. 1Q net sales are expected to be down by about more than 20% down. They're expecting a loss per share of 35 cents to 75 cents and an adjusted loss of anywhere from 40 cents a share to basically zero here. And they're actually citing, Scarlett, the impact of this cybersecurity attack, which we kind of knew about. They kind of gave that disclosure here, but we've learned a lot more detail, saying that this is apparently from the same group that hacked the casinos in Las Vegas here. So they're now sort of putting a number on it here, and this does not look good. Remember, they basically had to shut down some of their direct-to-consumer sites that were selling products, and some of their logistics operations also were impacted by this as well.
I suppose the only good news there is that this is a one-time event, and once it's resolved, it's not going to be recurring, right? It's not an operational issue. It's more of bad luck and perhaps bad security, but that can be addressed on its own. Yeah,
Clorox scheduled to report its full earnings for the fiscal first quarter on November 1st. Meantime, here we're going to go down to Lower Manhattan, where Sam Bankman-Fried's opening arguments in a historic fraud and money laundering trial taking place. We're going to be live at the courthouse. This is Bloomberg. All right, right, we're getting a glimpse inside the trial of FTX co-founder Sam Bankman-Fried, charged with 7 counts of fraud and money laundering. The opening remarks began today with prosecutors saying Bankman-Fried lied to the world. Bloomberg's Sonali Basak is outside the Manhattan courthouse with a little bit more here. And it was interesting, the prosecutor talking a lot about how basically this whole persona, this whole business was built on lies here. The defense had a chance to rebut that. What did they have to say, Sonali?
Yeah, the defense's argument here is really important because you do have Sam Bankman-Fried fighting this tooth and nail. Part of the defense, as we have learned today, includes this idea that a lot of what was happening between FTX and the lending of funds to Alameda was not only known, but known between company insiders as well as people who had lent money to the firm, as well as people who had known that the relationships in good times didn't mind that the two companies had this kind of a relationship. And then over time, it deteriorated as the crypto industry got very volatile and money was lost. Caroline Ellison is a key figure for both the prosecution and the defense. When you look at the defense, they had said that Sam Bankman-Fried guided Caroline Ellison to do more to protect Alameda as a shareholder of Alameda when the crypto crash was starting to arise. His worries about crypto going south instead of just upward as it had before that time. And so this idea that poor risk management, according to the defense, is not intentional fraud, and that will have to be proven here in court for Mr. Bankman-Fried himself.
So this trial is just getting started. It's likely to take up to 6 weeks. What other witnesses are we expected to hear from and to see?
Well, what's interesting is this is moving pretty quickly. Historic days, I've been saying, you have heard from the opening remarks from the prosecution and the defense. They are already actually inside right now, wrapping up very quickly, but they have started here, Scarlett, to interview witnesses, one of the early ones being a developer at FTX and a college friend to Sam Bankman-Fried, who had said that he had gotten an immunity order here to be comfortable in order to testify, and that he may have unwittingly been developing things that had ultimately led to this alleged fraud that he did not know of. Then tomorrow is a very big day because we're very likely to start hearing from Gary Wang, who was the former chief technology officer of FTX. Like I've been saying, we don't know exactly when Caroline Ellison will be testifying, but she is expected to testify. There are other star-studded figures expected to testify, including Sam Bankman-Fried's brother, who had been in charge of a lot of his political donations and his foundation, as well as Anthony Scaramucci, who Skybridge had taken money from FTX and counted FTX as a shareholder. So over the next 6 weeks, some critical names we'll be hearing from that'll be closely watched, but certainly a lot happened here today and a lot will be happening here tomorrow.
Sonali, quick question. Is Sam Bankman-Fried himself expected to testify at all?
So at this point, he is not. The judge reminded him yesterday that he certainly has the right to testify. The other set of folks at this trial that have been here in his support are his parents as well, which is why it makes it so interesting that his own brother is expected to be testifying. At this point, he is not expected to testify. We have seen Sam Bankman-Fried come to the fore and speak very openly about his own involvement in FTX and the downfall before this indictment came down. Let's see if he has the same sort of tone of heart when we come to the end of this trial.
Sonali Basak, downtown Manhattan. Here is day 2 of the Sam Bankman-Fried trial. We'll be covering that, of course, as long as it goes on. Meanwhile, we want to go back out to Capitol Hill and the future of the House of Representatives. A sit down with Senator Richard Blumenthal of Connecticut. That's coming up next. This is Bloomberg. Romaine Bostick with a look at how the markets performed here on this day, and at least for a certain period of time, it performed pretty well. We had a relatively strong open, though that did start to fade about midday, and then we saw a real pickup in activity as we got into the final hour of trading. You could thank the Magnificent 7 stocks for that, all 7 higher in the green on the day, and that's a big part of the reason why you saw the Nasdaq up 1.3%, the Philadelphia Semiconductor Index up more than 1%, and even the S&P 500 at one point flirting with the 1% gain on the day. You did not see much in the cyclical trade, and I think that is indicative of the big downdraft that we saw in energy stocks today. They were the primary laggard, with all of the major oil and gas companies, the oil field services companies, and the refiners moving lower here on the day. A 5% drop in WTI crude contributing to that downdraft. The VIX still elevated, but not quite at the 20 levels where it was the other day here. As far as a full-on embrace of risk assets, this is a market right now still looking for a little bit of more clarity as to the inflation picture out of the jobs numbers. We got jobs numbers yesterday in jolts. We got some today, private payrolls out of ADP. We get jobless claims tomorrow, and of course, the big monthly report on Friday. What that amalgamation of all that data is going to tell the markets remains to be seen, but for at least right now, Scarlett, we can tell that this is a market clearly responding almost in lockstep with what those numbers show.
Yep, and of course, the data continues to roll on. We get jobless claims tomorrow and the big jobs report on Friday. Meantime, in Washington, Congressman Jim Jordan and Steve Scalise have both raised their hands in a bid to be the next Speaker of the House. This follows the unceremonial ousting of Kevin McCarthy yesterday by a conservative faction of House Republicans. President Joe Biden earlier spoke out about the dysfunction in Congress.
We need to change the poisonous atmosphere in Washington. You know, we have strong disagreements, but we need to stop seeing each other as enemies. I join with Minority Leader Jeffries in saying that our Republican colleagues remain committed to working in a bipartisan fashion. We were prepared to do it as well for the good of the American people.
Joining us right now, I'm pleased to say, is Senator Richard Blumenthal, Democrat from Connecticut. Senator, thank you so much for taking the time to speak with us. Give us your sense first. How frustrated are you and other senators with what you are seeing take place in the House of Representatives?
I am frustrated beyond words. There is this obstacle to governance. You know, we have our disagreements. We differ on issues, but what's happening in the House is just total chaos. They cannot literally vote on bills, move bills to the floor, even perhaps engage in the conference committee on the National Defense Authorization Act, on the Armed Services Committee. All around the world, our troops are serving, our law enforcement agencies are working, our emergency responders are on the job, and Congress is paralyzed by this far-right extreme group. It's a narrow slice of the Republican Party, but it has managed to throw the House of Representatives into chaos. And by contrast, here in the Senate, we are moving ahead in a bipartisan way.
So there is some breathing room until November 17th, right? Because the stopgap funding measure takes you to that point. What are you and your peers doing in the Senate right now to prepare matters so that if there is no House Speaker, something could possibly be done from your end?
It's a great question. We will be moving ahead with the 12 appropriation bills. Remember, the Appropriations Committee votes on the bills. These votes were unanimous for the majority of these bills, bipartisan votes on the others, overwhelming approval, and we're going to be voting on them in the Senate. We have to do our job, and we're going to just let the House hopefully do its part, but we have to move ahead.
We have to move ahead, of course, but you guys, as you know, Senator, are more or less joined at the hip to a certain extent. I mean, just the sort of construction of our democracy and what the Constitution lays out. You know, there has to be some sort of cooperation between the two parties and, for that matter, the two houses of Congress. I am curious as to whether you see I guess any change, in the climate, like what sort of arrests this sort of dissent that we've seen right now with regards to the dysfunction and the inability to do something basic, and should I point out, something that is constitutionally required by members of Congress, and that's to pass a budget.
Let's be very clear. I know that there is this narrative about dysfunction, but I want to just commend my Republican colleagues, as well as our Democratic members of the United States Senate. We've worked together. When you say dysfunction, the majority of members of the House of Representatives are in favor of aid to Ukraine. I've been a champion of providing Ukraine the tools it needs as it seeks to win against this murderous Russian aggression. And there is certainly a majority in the United States Senate as well, because we recognize our own national security is at stake. We're talking here about a murderous dictator who will keep going. Putin will go against Poland and other Eastern European countries if he wins in Ukraine. So our national security is at stake. And the idea that we're dysfunctional, yes, the House of Representatives is dysfunctional. And it's not Democrat disagreeing with Republicans, it's Republicans disagreeing with each other, because there is this extremist right-wing faction that essentially wants to roll back the clock on climate change, on worker protection, on women's health care. Yeah. They are really intent on
I hear everything you're saying, but I'm sure, as you know, I mean, these people have, for lack of, a better reason, they have a tremendous amount of power right now, given just how narrow the majority is in the House of Representatives. It doesn't appear that the next election is really going to change at least the balance in any material way here. And we should also point out, too, that a lot of the folks who sort of led to the standoff over the debt ceiling, led to the standoff over the shutdown, and effectively forced out their own speaker, these are also people that are relatively aligned with the front runner in the Republican Party's nomination process for president.
Well, yeah, and that's a pretty good argument for turning the tide in the House of Representatives and defeating this small right-wing extremist faction by electing a different majority. I hate to be partisan and sort of blunt about it, but we have to break this fever. And by the way, it's not just a fever in the narrow political partisan sense. The biggest threat to our country's internal security is domestic violence, the violent extremism that is legitimized and, in fact, given license by some of the talk by that narrow right-wing fringe. So it's the broader threat to our democracy that's involved.
Yeah, there's a lot that needs to be cleaned up based on what you just said there. What is your message, Senator, to the business community, to the investment community, particularly those who are lending us money from overseas and are not as well versed in the mechanics of the Constitution and how we go about everything, and are fairly appalled by the political theater that they're witnessing?
My message is, we are the greatest country in the history of the world, and we have a record of stability. Even though we may come to the edge of the cliff sometimes, we don't go over it, and we will get it done in the next 45 days, what needs to be done, because there's so much at stake. And the other message I would convey is, we need to come to the aid of Ukraine right now. We need a supplemental. $24 billion is what the president's requested, but I think that amount may be larger. And there is an urgency here for our European allies, NATO, as well as our nation. I've been to Ukraine 4 times in the last 18 months. I visited NATO during my last trip in August, and our allies are solidly behind this cause as long as we give Ukraine the tools it needs, we meaning NATO and the United States, it can win. And there is an urgency for time.
All right, Senator, appreciate you taking the time for us. That is the senator from one of the senators from Connecticut, Richard Blumenthal there. And be sure to tune in to Balance of Power coming up at the top of the hour, where they'll have a sit down with Republican Representative Matt Gaetz, of course, who's been at the center here of the ousting of the Speaker of the House, Kevin McCarthy. A big question now as to who replaces him. Courtney Gelman joining us right now, Managing Director of Policy Research over at Strategas Securities, a Baird company. And Courtney, let's start off here with who could potentially replace him. There's been a lot of discussion about Matt Gaetz himself, Steve Scalise weighing in, saying that he does plan to run for that position, as well, of course, as Jim Jordan. When I listen to those names here, I wonder, are we going to end up with somebody who's materially different than what Kevin McCarthy brought to the table?
Well, I think, when you're looking at Steve Scalise and Jim Jordan, they are the front runners. They're also both more, I would say, conservative than Kevin McCarthy. So that's what we could end up with. We don't think that either of those candidates right now currently has the votes, though. So for the next week, it's going to be a lobbying effort to see if they can consolidate the votes. The moderate members are going to be really important there. But we do think that there's a risk. They're going to be voting potentially on Wednesday. We don't think that they're going to have a speaker on Wednesday. We think that this vote could last several rounds, similar to something that we saw in January when it took Kevin McCarthy 15 rounds to secure the speakership.
Yeah, I mean, we kind of forget that. So, I mean, anybody who comes in probably could be facing that as well. Maybe not 15, but it may not be a first ballot type of thing. I am curious as to what the potential impact is of not having a permanent speaker. There's been a lot of talk about Patrick McHenry and sort of what power he even has to do just basic functions other than just keeping the lights on.
Yeah, we read Patrick McHenry's powers as essentially trying to get to a new speaker. So can't really do much. Committees can still meet. There can't be any floor action. But that's really important in an environment where we have less than 45 days before the continuing resolution is up on November 17th. So certainly when you're talking about the fact that government funding has to be dealt with, all of those concerns that we had just a week ago about potential credit downgrades, lack of economic data, those come back into force once we get to November 17th if they haven't made any progress.
So in thinking about who's going to be the next speaker, I guess it's not all that, I mean, what might be most surprising out of all of this is that Kevin McCarthy did last for as long as 9 months, given the concessions he had to make in order to become speaker after those 15 rounds of voting. What kinds of promises will the next speaker need to make from both moderate Republicans and Matt Gaetz's camp in order to win the gavel? And because that's important to understand in terms of projecting out how effective that speaker will be.
That's a great question. And I think, the honest answer is we don't know yet. We don't know what those negotiations are going to have to entail, because the thing with narrow majorities is both camps are empowered. You have the very conservative end, but you also have the moderate end. And you're already seeing some moderates, like Representative Lawler of New York, who is in a Biden +10 district, saying that he wants to see reforms to the motion to vacate in terms of how he's going to vote for a speakership. And then obviously you have the 8 members who voted against McCarthy and the demands that they're going to have. So it is going to be really difficult for the new speaker, whoever that person is going to be, to again secure the necessary votes. That's why we think that this could take more than a week to get there. And it's just unclear at this point what those demands are that they're going to have to promise to either camp.
And just a real quick question here, Courtney. We only have about 10 seconds here. Do you think that there will be any help from the Democrats, or are they just going to sit by and sort of let them twist in the wind?
Given what happened on the speakership vote, I do not think that there will be any help from the Democrats.
All right, we're going to check in with you again soon, I'm sure. Courtney Gelman there over at Strategas Securities. A look here at the drama unfolding right now in the House as they try to find a new Speaker of the House. Coming up here, the summer of strikes now becoming, well, an autumn of strikes. We're going to talk about the many labor disputes out there impacting the U.S. economy, including a new one today. Healthcare workers over at Kaiser Permanente walking off the job. Art Wheaton from Cornell's ILR School is going to be joining us after the break. This is Bloomberg. All right, a focus on the labor market right now. First, of course, it was Hollywood, then it was the auto workers, and now it's healthcare workers, 75,000 of them over at Kaiser Permanente, taking to the picket lines today. Now, this is an organized 3-day strike, but it is expected to shut down services for most non-essential health services for about 13 million people across 6 states here in the U.S., making it the largest strike by healthcare workers in our history. Ian Colgren of Bloomberg Law joining us right now to talk a little bit more about this. And first, let's just start off with the brass tacks here. Ian, what exactly are these workers demanding?
Right. These workers have a list of demands and grievances dating all the way back to the COVID-19 pandemic that have not really been solved. Above all, they say staffing is short in a lot of these clinics. Workers who were burned out and left during the pandemic have not been replaced for cost-cutting measures, according to the union, and it's created an untenable situation for the workers there, and they say for patients too.
All right, Ian Colgren there over at Bloomberg Law. Let's continue this conversation and broaden it out just a little bit with Art Wheaton. He's the Director of Labor Studies at Cornell School of Industrial and Labor Relations. And Art, let's start off, I think, with that last part of the title here, because this has been a year, quite frankly, where we've really seen a lot of these labor unions flex their muscles. And I assume that's directly correlated with just how strong the labor market has been as of late.
Oh, absolutely. I think you've seen that we've had the COVID causing issues with supply chain, causing huge issues with inflation, as everybody's aware of. But it also has happened with a very low unemployment rate. So right now, the labor market, the balance of power is on labor side. And more importantly for today, it's much more consumer and public support for unions. We're at nearly record high since the 1960s for the public supporting the unions and agreeing with many of their positions.
So the unions maybe have a little more popular support behind them. Ian, who we're just talking to, he and his colleagues at Bloomberg Law have found that Kaiser Permanente has been involved in 5 of the 15 largest strikes recorded. Can you give us a sense when it comes to this Kaiser strike, what kind of relationship that firm has with its employees? How well do they work with their unions?
Historically, Kaiser Permanente has been one of the examples we use for joint labor management, so that they've actually had many good things happen through Kaiser Permanente. I have done training with many of their employees in California over the years, and they really do try to get along. But that doesn't mean all the problems you face at the bargaining table are easy.
Yeah.
So while the union has some very legitimate concerns and some grievances and some expectations, management's facing some tough issues as well with how much they're getting paid for, whether it's Medicare, Medicaid, and they're facing rising costs as well. This isn't easy for anyone, which is why you lead to a strike.
Right. And the issues that they need to address go back a long way. I think about the auto workers union and how they're talking about concessions they made back in 2008 and how they want to turn that around. And in the Kaiser instance, a lot of this dates back to the pandemic, and it was magnified by the pandemic with staff shortages, burned out employees, deteriorating quality of care. How do they address these short-term and long-term issues in these kinds of high-stakes, pressurized situations? What is the best way forward?
Well, we faced a very similar strike here in Buffalo for the Catholic health system. We faced very serious bargaining issues, and you have to push on trying to make sure you can raise the staffing levels. Part of the reason why it's only a 3-day strike, it's not an indefinite length, is these healthcare workers care very much for the patients. And they would really like to have enough people there working so that they can feel like they can care for the patients adequately. So you have to find ways to hire additional people. One of the solutions here in Buffalo was to close some of the smaller clinics so that you could take the staff from there to make sure you have enough in the other hospitals. So it may be reducing not the number of people, but some of the locations to make sure you have enough people to do the job. It's not a simple process here.
Yeah, and prior to this spate of strikes that we've been seeing across a variety of industries, Art, we had talked a lot about kind of the decline in union membership, at least here in the United States. And I am curious as to what sort of has been the effect, if we can sort of extrapolate so far with some of these labor strikes. Has this created new interest in unions? Are we seeing membership go up, or is this just kind of going to end up being kind of the same group of people a year or two from now that we had a year or two prior?
Well, part of it is how successful are they? So you can look at the Teamsters and UPS, which did not have a strike, but they threatened one. They ended up with huge increases. That goes a long ways to helping them try to organize, whether it's Amazon or FedEx or other people who deliver packages. You saw huge raises at the Writers Guild. That can help with the actors' equity strike. So as they get success in bargaining, whether it's through a strike or avoiding a strike, that will help increase your ability to unionize. The biggest obstacle has been our labor law has been broken since 1947, and we just can't get 60 senators to agree on which direction, whether it should be more towards the union or more towards management. Yeah. Right now, labor law is heavily on the management side.
Yeah, and it doesn't look like that's going to change anytime soon. And even if you go at the state level, Art, I mean, you've seen, obviously a lot of these right-to-work laws that have come out of these state legislatures. And then the idea that we've actually heard kind of implicitly some of these companies, particularly in the auto sector, kind of almost threaten, basically say, look, if this becomes a bigger issue that we're going to have to keep dealing with, then look, we're just going to find areas where we can relocate our plants to some of these right-to-work municipalities.
Absolutely. There's always been that threat. Capital is mobile. They can move where they want. That's where healthcare and services, they're not necessarily going to say we're going to move all our hospitals and move them to Mexico or Canada and try to help our patients. There's 13 million patients that want to get served and getting taken care of by Kaiser Permanente, and it's not going to be easy for them to go elsewhere. So for this case, there's a lot of the same issues. People want to get paid well, and you want to have better living and working conditions. And collective bargaining is the one method we use to try to get there. It's a messy process. It takes a while, but it's been the most effective.
All right, Art, great stuff. Great to talk to you. Art Wheaton there. He's the Director of Labor Studies over at Cornell School of Industrial and Labor Relations. All right, coming up here on the big program, we're going to set you up for what financial markets will have their eye on tomorrow. This is Bloomberg. A lot that the market will have their eyes on Thursday, including a lot of earnings tomorrow.
Yeah, we've got Constellation Brands, ConAgra Brands, and Lamb Weston, which I had to look up, but they make
delicious
fries, right?
Delicious, and that beer here. We're also going to get some economic data, jobless claims, the weekly numbers tomorrow.
Yeah, jobless numbers or jobs numbers all this week have really moved the markets. This one will be critical.
We're going to get a lot of Fed speak tomorrow as well. And an interesting meeting here. The EU and Ukraine are supposedly going to be meeting as well.
Yeah.
There's been a lot of talk about
especially as Ukraine waits for some kind of U.S. funding, some kind of U.S. aid, which is not forthcoming right now because we have no speaker.
Yeah, absolutely. And speaking of which here, we're actually going to hear from Matt Gaetz, the Republican from Florida, who actually is at the center of all the turmoil going on in the House, the Balance of Power crew. They'll have that interview coming up in just a bit. Scarlett and I will be back tomorrow. This is Bloomberg.